Top experts, great questions.
Welcome to the European Market Open, everyone. A minute to go until the start of cash equity trading. I'm Francine Lacqua in London with Tom McKenzie.
And here are your top stories. China's consumer spending and industrial activity disappoint in April, calling into question the strength of the economic recovery. US futures fall ahead of DC debt talks. Treasury Secretary Janet Yellen says the US is already paying a price for the stalemate. Plus, UK wage growth accelerates in the first quarter, suggesting persistent inflationary pressures. Sterling sinks.
So, Tom, this is a look at the futures. I have to say, we were up and now we're seeing a little bit of pressure on the DAX, down 0.1%. Same, actually, for some of the other indices around the world. Japan actually boosted higher by some optimism in the economy. Overall, U.S. futures also pointing higher, but we're not sure why.
Yeah, Fed officials coming out, and a number of them suggesting that maybe they're comfortable with a pause coming through from the Fed in terms of their decision-making. And, of course, you have those debt ceiling talks. The Republicans, McCarthy, coming out and saying there has been no progress so far. The two sides set to meet later today, of course, consequential, and we watch to see if the president does indeed fly to the G7 for those meetings. The FTSE 100 currently down 0.2%, lining up with the futures, which pointed to a bit of a risk-off sentiment across these markets. The China data then, that disappointment, as we said, across the data spectrum coming out of China. But for me, what really stood out was the unemployment rate amongst the young population, 16 to 24, at a record high. That is a major concern for the government of China. The response, of course, in terms of the fiscal and monetary response, is going to be crucial. The CAC current over in France down 0.3%. The FTSE 100, of course, here in the UK down 12 points. We're looking and gauging that wage data and the unemployment numbers. So some claims ticking up, the wages coming in higher than the previous month, but slightly lower than estimates. So a bit of a mixed picture, but as we mentioned, the pound taking a hit, and we'll look at that shortly. The Italian FTSE currently down 0.2%. A telecom story there as well to unpack. And in Spain, the IBEX off by 11 points. Across these assets, then, let's switch it on, see how things are shaping up. The focus on Japan, really interesting story there, just highlighting for you as we switch the board in terms of the topics, getting back to levels last seen in the 1990s. Japan is looking attractive to many an investor. There is no recession in line, or at least being lined up for Japan at this point. And of course, inflation and the inflationary dynamics there are very different indeed. The corporate impulse around returning cash to shareholders has driven this rally as well. We'll see if that can continue. Can Japan be an outperformer this year? The futures in the US pointing lower by 0.3%. Sterling, there's the knock there, down 0.3%, pairing some of the heavier losses on the pound, 124 on the back of that wage and jobs data. And Brent, $75 a barrel, just down 0.2%. The news that the US is looking to refill those strategic reserves, maybe putting a floor under the price there, $75 a barrel on Brent as things stand. Fran?
Tom, so there are 20 groups that make up the Stock 600, and actually all of them are on the downside. So we're seeing a lot of pressure on telecoms, for example, down 0.8%. Basic resources, construction, really there are only two industry groups that are on the rise today overall as an industry group, and that's technology gaining 0.2%. Utilities also on the up. But of course, a bit of worry about volatility going forward, and then margins is probably the one thing that analysts are trying to figure out.
Okay, we kick off here in the UK then. Wage growth, as we mentioned, accelerating in the first quarter, suggesting little let-up in the inflation pressures worrying the Bank of England. Let's get the analysis then with Bloomberg's UK correspondent, Lizzie Burden. Lizzie, let's break down these numbers then for us. What stood out to you?
Well, actually, Tom, Bank of England bets have been pared back off the back of this data. And as you say, the pound has fallen against the dollar and the euro. And what markets seem to be focusing on is the payroll numbers, a big miss there. But economists that I've just been speaking to are saying this is subject to huge revisions. So what they're actually focusing on in their commentary this morning is the narrative that, yes, the labour market's still tight, but you're seeing signs of cooling. So if you look at unemployment, it held steady, but actually you saw it was expected to hold steady, but it ticked up slightly. Pay growth wasn't as high as expected, but there was still an increase, and economic activity fell. But you did see a record in terms of the number of people who are economically inactive because they're long-term sick. Now, that's not a good look for the government, given it's one of its top 5 priorities to cut National Health Service waiting lists. And they're not going to be helped in that endeavour by another figure out this morning, which is that the number of days lost to industrial action was up again in this data, including doctors and nurses. So you can see the strikes problem feeding into the inactivity problem, adding more pressure on the government to settle with the unions.
Lizzie, we also heard from the BOE chief economist Hugh Pill, really interesting on AI and how that will transform our economies going forward. Any clues on the future path for rates?
Yeah, really interesting comments on AI, saying it could be a win-win in terms of boosting productivity and living standards, but also for the central bank's forecasts, which the former Bank of England Governor Mervyn King was on Bloomberg TV complaining about yesterday. Can the bank claim to be that accurate in its forecasts at this moment, given the war in Ukraine and the pandemic, of course? But in terms of the future path for rates, Hugh Pill says he hopes that the hikes are over. It's the clearest sign yet that we've had that the tightening cycle may be soon done. And he did take the opportunity to apologise for his language when he said that Britons need to accept that they're poorer. He said that he acknowledged that it is the poorest Britons who are going to suffer the most, but he says it is the blunt tool of interest rates that's going to have to be used to deal with this inflation problem.
Lizzie, thank you so much. Our UK correspondent there, Lizzie Burden, with the very latest on the UK. Now joining us to dissect markets is Tristan Hanson, multi-asset fund manager at M&G Investment. Tristan, thank you for joining us. I mean, there's a lot going on, future path for interest rates, but also trying to understand inflation. Then we have this good story on Japan today. What do you think will be the main diversification of how you win at portfolio management and you don't in the next 3 months?
Well, I think one of the major features so far this year is trying to keep things quite tight, because it's been a very uncertain, difficult economic backdrop whereby you've had ongoing strength in the labour market until recently, perhaps, and some of that UK data is quite interesting. While some of the other indicators have been softening a bit, meanwhile, rates have carried on rising, and yet the market is pricing in rate cuts. So it's been quite a convoluted, difficult backdrop, dealing with all the consequences of COVID and war in Ukraine, etc. I think the key going forwards here is going to be to watch the labour market and those jobless claims data in America on Thursday and on ongoing weeks. Because if that labour market cracks, then I think the narrative about inflation will fall to the background, and it will be more about growth and jobs growth.
And it will give clarity, clearly, in terms of where the Fed goes next. Are you ready? It sounds like you may not be ready to bank on a pause yet from the Fed. Are you starting a position around that? Do you push back on the idea, the bets that there are going to be cuts coming through towards the end of this year?
Yeah, we wouldn't position around an individual meeting or an individual couple of meetings, but I think we are towards the end game of this rate hike cycle, because you're already seeing cracks in the system with regards the banking system in America, the jobs data potentially softening here. They've done a lot. They've done 500 basis points since the lows. These effects always work with lags.
Yeah, but just so you're expecting a pause in interest rate hikes. Are you actually expecting a cut, or is that wishful thinking from the markets?
Who knows? I think I'd be surprised if they're cutting this year, but in the last few cycles when they have started to cut, they tend to cut by quite a lot over the course of the subsequent year. So on a risk-adjusted sort of probability basis, the market is pricing in some chance of cuts, but if they cut, they'll probably be going further. And that's how you get this kind of expectation of rate cuts on a sort of risk-adjusted basis.
Can they cut and keep quantitative tightening going? How are you thinking about the path forward for QT from the Fed?
Well, it's a complicated situation, isn't it? I think the direction of change will be towards easing off, and then they've got time now to wait and see what the after effects of the 500 basis points so far has been. And I don't think they need to be in a hurry at this point in time. Inflation's already starting to come down a bit. I think pausing makes sense here.
All right, Tristan, thank you so much. Tristan Hansen, they're a multi-asset fund manager at M&G Investment, stays with us.
Okay, let's check in on some of the stocks on the move for us today. A couple of telecom companies, Vodafone updating in terms of its strategy. The relatively new CEO at the helm of that company, of course, the earnings numbers coming through as well. But in terms of detailing efficiencies planned, including about 11,000 jobs to be cut, they are reassessing the business, strategically reassessing and reviewing the business in Spain and Germany, so crucial for Vodafone as well. That remains in focus. They're trying to streamline this business. Currently, the stock is down around 3%. The fourth quarter services revenues actually came in as a beat, but this is the restructuring and a few more details coming through from the new CEO in terms of how to position this company. They are, though, forecasting essentially flat revenues for the year. Telecom Italia, bad news in terms of the bidding process, at least from the perspective of Telecom Italia, one of the big state lenders over in Italy, pulling out and ending its bid for the networks business of Telecom Italia. There was a bidding war going on with KKR, and that is a part of the Telecom Italia business that had been at one point valued at about 21 billion US dollars, the network parts of Telecom Italia. So that moves to KKR in terms of their response. Boohoo coming in with an upgrade, a little bit more optimistic after the struggles in terms of supply chains and inflation, of course, for the fast fashion retailer. Look at that, the stock rallying 11%. A little bit of respite as they upgrade their guidance in terms of what they expect for the rest of the year, improvements that they're seeing coming through from the cost cutting at Boohoo, and they are starting to see a little bit of deflation in the supply chains as well. So a little bit of optimism coming through for that stock that has been under pressure. Right, coming up, Atlanta Fed President Raphael Bostic says he would hold off from raising interest rates again. More from our exclusive interview. That is next. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. season is here.
We haven't had a shocker yet.
They are minting money.
Markets are still volatile.
I think it's going to be choppy.
Bloomberg breaks the numbers first.
First quarter results, impressive.
The revenue beat is amazing.
With exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market?
Do we get answers to that today?
The bottom line speaks for itself, and that's what moves markets.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Look, in today's environment where there's so much uncertainty in the economy, I don't think we can really rule out anything. If I had to have a vote right now, I'd probably vote to hold. But as you noted, we got 2 more inflation readings. We have a jobs report that's got to come out. There's a lot more information we're going to have as to what's going on.
We at the Federal Reserve probably have more work to do to try to bring inflation back down. And most importantly, we should not be fooled by a few months of positive data. You know, we still are well in excess of our 2% inflation target, and we need to finish the job.
Atlanta Fed President Raphael Bostic and Minneapolis Fed President Neil Kashkari on the U.S. Central Bank's next move to tackle inflation. Now, still with us, Tristan Hanson, multi-asset fund manager at M&G Investment. Tristan, thank you so much for sticking around. When you look at the Fed calls and actually the path forward for inflation, I think you believe that we could be at a turning point and that we could see a recession. What does that mean for where you want to be fully invested in?
Well, the difficult thing with the bond market is the market's already pricing cuts to a degree. The long end of the curve, I think, is potentially more interesting because on a multi-year horizon, you've got 1.5% to 2% real interest rates if we're right that inflation comes back down. In the long run, there's a question mark over that, but if we start to worry about growth first, the market, I think, will put aside concerns about inflation for the time being, and therefore those bonds could be, quite attractively valued at a positive real yield.
Oh, sorry, maybe look at the long end of the curve with the 10-year. You could lock in, 346 on the 10-year, 380 on the 30-year in the US. The earnings picture has been relatively resilient. Do you see that resilience holding up amid that concern around slowing growth?
I think it's going to be difficult because if you look at that, that has been a surprise so far because at the back end of last year, people were waiting for earnings to sort of fall off a cliff. They've been relatively resilient, although not fantastic in aggregate, but that's been enough to get the market higher. But if we are at a turning point in terms of growth, and also once you factor in the tightening of financial conditions, the problems in the banking sector in America, the fact that if you're a high-yield borrower, your cost of borrowing has gone up now towards sort of high single-digit, up towards double-digit in some cases. I think all of that cumulatively is going to be a headwind to profits, and given where the S&P's rating is, 18 times PE on a forward basis, I think it's going to be a challenging backdrop.
So what does that mean for what you want to sell right now?
I wouldn't be overweight equities. We're kind of neutral to underweight, depending on which mandated it is, but we're certainly taking a more cautious approach there. There is more value outside of the US, I would say. So if you look at Asia, there's a lot of value there. There's not a lot of optimism. Japan's got a decent valuation and a good story in terms of corporate reform.
Do you lean into Japan? We've seen the topics at 1990 levels. Today, there's the corporate buyback story, there's the cash back to shareholders story, the fact that they don't have a recession, it kind of built up, at least for that economy. Is there further upside? Does Japan outperform?
I think on a medium-term view, there's quite a good story there. One needs to be careful about chasing markets when these stories come to the fore, because often they come to the fore after the price action. But I think having positions in Asia, in Japan, and being more cautious on the US makes sense on a medium-term point of view.
Tristan, are there parts of the U.S., though, that looks attractive? We have the Inflation Reduction Act coming, and I know that could be even more inflationary, but at the same time would give a boost and kickstart a lot of the renewable energies.
Yeah, true. I mean, the question is which companies are going to benefit. Are they exclusively US, or are you going to get beneficiaries overseas as well? I just think in the aggregate, there's a bit more optimism priced into US valuations than there is in the rest of the world, and therefore, on a broad sort of macro basis, there are going to be better opportunities outside of the US.
And it's been a narrow rally as well. It's been a concentrated rally. Big tech has been a big component, of course, in the upside that we've seen year to date in US equities. Do you need to see that broaden out as well?
Well, typically, I'm not a chartist or technical analysis, but typically they would be concerned about rallies that are very narrowly led by just a few companies. Yeah, I think we've been in this kind of holding pattern for a few weeks now with very little movement in the overall index. I think if we get some volatility in the macro data, which would be my expectation from here, then I think we could see some breakouts of the existing status quo.
What looks, something that you'd want to buy right now that no one else is seeing? Is there something secretive on the market that we should be looking at?
That's always a tricky question, isn't it? Because what can I see that others can't? I would say, I would look at
Well, that's how you earn your fees.
Well, that's right. Well, taking good risk-adjusted probabilities. I would say Asian markets are an interesting area. And if you're worried about a global growth shock, then I think there's some value in those long-end treasuries.
Okay, long-end treasuries and maybe tilting towards Asia. Tristan, thank you very much indeed for your time this morning. Tristan Hanson, multi-asset fund manager at M&G Investments. Okay, let's get the Bloomberg Business Flash now with Sarah Hall. Sarah.
Hi, Tom. Microsoft's takeover of games maker Activision Blizzard has won approval from the European Union, putting the bloc at odds with regulators in the UK and US. The EU says the $69 billion deal is pro-competitive and would kickstart the nascent market for cloud streaming games. Microsoft is mounting legal challenges to the rulings, blocking the deal. Bloomberg has learned that Amgen's deal to buy Horizon Therapeutics is to be challenged by US federal regulators. The Federal Trade Commission is expected to file a lawsuit later today to block the $27.8 billion biotech deal on fears it could hamper innovation and slow the pace of drug development. The US is preparing to buy up to 3 million barrels of crude oil to refill its strategic petroleum reserve. The country's emergency stockpile is at the lowest level since 1983, after a release of over 200 million barrels to curb high energy prices last year. Deliveries into the government reserve are planned for August, with contracts to be announced in June. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Sarah Halls, and this is Bloomberg. Tom, Francine?
Sarah, thank you so much. Sarah Hall's in Dubai. Coming up, the latest Chinese data shows that the country's post-pandemic recovery is actually losing momentum. We dive deeper into that next, and this is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Welcome back to the Open, everyone. We are 22 minutes into European trading day. Tom was telling you, if you look at the markets, a little bit of concern about maybe margins going forward. And then overall, the good news from Japan that lifted a lot of the Asian stocks. That's also lifting some of the U.S. futures, not really translating at the moment European stocks, but they're kind of moving sideways. If you look at the DAX, it's pretty much flat. So China's consumer spending and industrial activity grew at a slower pace than expected in April. That's adding to concerns that growth in the world's second largest economy is losing momentum. Now let's bring Bloomberg's Jill Dices from Hong Kong. Jill, good morning, good afternoon. Talk us through the data.
Yes, good morning. I think that at this point, what we're seeing is a pretty significant slowdown, or at least like some signs of fragility within the economic recovery picture in China right now. We, first of all, we're comparing numbers to April 2022 when Shanghai was locked down. So I think given that weak base, we were expecting big pops in industrial output, retail sales, maybe even a pickup a bit in fixed investment. And we really didn't get a lot of that. Industrial output grew year on year at about half of what economists were expecting. Retail sales popped 19% or so, but that was still also under economists' expectations. And fixed investment actually gave up a bit of ground. It decelerated a bit in the first 4 months of the year. So ultimately what this is pointing to are some pretty big concerns about the sustainability of this economic recovery in China. Now, of course, we had already been seeing some signs of maybe a weakening there with property investment. We also have seen in recent weeks inflation is was almost at zero, I think, when it was reported just a few days ago or so. And then trade as well has been struggling. So all of this kind of paints this picture of maybe the economy needs a bit more help going forward.
Yeah, indeed. The other line that really stood out to me was the unemployment rate amongst young people, so 16 to 24, at a record high of plus 20% for China. You're not far off Italian and Spanish levels of youth unemployment now in China, and that's just the official number. The question for investors then, Jill, is how does the PBOC react? Do they come out with all guns blazing?
Yes, and I'll point out just on that youth unemployment rate, that's probably only going to get worse in the coming months as more graduates enter the market. Now, on the policy side, what we've seen so far from the PBOC, the People's Bank of China, is really sort of a wait-and-see approach. They had an opportunity to cut a policy interest rate yesterday. They didn't take that chance. What we're seeing from economists is these further expectations. Maybe it's not in the first half of the year, but maybe it comes in the second half of the year of a policy interest rate cut. The PBOC might also have some additional room to move there, considering the Fed is likely going to pause its rate hiking cycle starting next month. So we'll kind of see whether that enters the equation. But we've also heard from a few analysts who say maybe there's additional room for fiscal stimulus. Maybe that comes in the form of subsidies, trying to encourage people to buy more electric vehicles or maybe home appliances or something like that. Because ultimately, this does come down to an issue where household and business confidence is going to have to be addressed if this recovery is going to continue.
Okay, great context. Thank you. Jill Dices out of Hong Kong on that China data. Let's switch focus to UK data, though. The growth in terms of wages in the UK coming in higher, wage growth, but versus the previous month, but not as high as some of the estimates. And you're seeing a repricing then in terms of across the gilts curve and also the pound under pressure as well, as markets start to reassess just how far the BOE is going to have to go. The Bloomberg economics team saying that this data shows clear signs that the heat is starting to come out of the jobs market here in the UK. And you can see that reaction across UK assets. Gilts yields down, the pound off by 0.2%. Stay with us. This is Bloomberg.
Manchester, not London, is the best place to find a new job in the UK. That's the surprising finding of data analysed by Bloomberg from Reed Recruitment. While you might think that London is the biggest pool of jobs, which it is, Manchester is leading the way when you look at the number of jobs per local worker. Thousands of voters in the so-called red wall seats flipped Conservative in the last election, hoping that the Conservative government would be able to bring more wealth and prosperity to their area. However, the data still show a country where employment prospects are thin on the ground in large pockets of the northeast, northwest, and areas all around the coast. Aside from Manchester, the only areas that are really leading the way are Cambridge, Reading, and Milton Keynes, indicating the good news for the rest of the UK might stop there. With Prime Minister Rishi Sunak facing the prospect of a general election as soon as next year, the pressure's now on for him to find ways to spread wealth outside of London to some of those more neglected areas. In Chancellor Jeremy Hunt's budget, he unveiled plans for 12 new low-tax investment zones around the UK and £760 million of spending on infrastructure and regeneration. Manchester's one of the oldest devolved areas in England, and there are signs that that's really beginning to pay off. What's on Jeremy Hunt's plate now is whether he can spread that success to other regions.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Welcome back to The Open, everyone. 30 minutes into the European trading day, and here are your top stories. China's consumer spending and industrial activity disappoint in April, calling into question the strength of the economic recovery. U.S. futures fall ahead of D.C. debt talks. Treasury Secretary Yellen says the U.S. is already paying a price for the stalemate. Plus, sterling drops on signs that the UK labour market may be starting to cool, even as wage growth accelerated again in the first quarter.
Let's check in on these markets then. You're seeing some downside across European equities. You can price in, of course, some of the China data and the disappointment there. When are we going to get these big banks readjusting their forecasts for China growth 2023? And will the PBOC, more importantly, step up with additional support? Currently, the downside for European equities, 0.2%. We continue, of course, to watch the politics of DC and the talks that are expected later today in Washington around the debt ceiling. So that's the downside across European equities. The DAX, though, just clinging on to some gains, adding 14 points. And here in the UK, the FTSE 100 just up 5 points, but flat, essentially, for UK equities. As we weigh up the data as well, a bit of repricing in terms of gilts, money moving in across the curve, yields down, the pound under pressure. Across these sectors, tech is performing quite well. Lower yields benefiting that sector, at least so far in the session. Tech up 0.6%. As a sector, bottom of the list, though, telecoms, and you can look to Vodafone, but Telecom Italia as well, and the decision by a state lender to pull away from a bid for the networks part of that business. Telecoms, the worst performing sector, down 0.6%, Fran.
Now, the latest 13F filings show Michael Burry, the money manager made famous in The Big Short, now has a big long when it comes to China. For more, let's head over to Valerie Teitel with the very latest. Valerie, tell us more about some of these positions.
Look, Michael Burry is going big on China. Over the course of the first quarter, he tripled his exposure to JD.com and doubled his exposure to Alibaba, taking his 50 billion portfolio, now exposed to 20% to Chinese tech names. Now, his 13F filing also showed he had hardly any exposure to U.S. tech. It was all China. As the tech trade heats up, he's clearly positioned for Chinese tech to outperform the U.S. He also was a big holder of some U.S. regional names, notably First Republic, PacWest, and Western Alliance. He's been quite vocal about his positioning there. Now, that stands at odds from what we've heard from Warren Buffett's Berkshire Hathaway. In their 13F filings, they actually show they exited their U.S. regional bank positions of BNY Mellon and U.S. Bancorp.
And Val, another trend that we're seeing in terms of these hedge funds is the money that is flowing into AI, the AI trade. What are the details on that?
Two of the most notable family offices, that's Tepper's Appaloosa and Drunken Miller's Duquesne, both increased their holdings of NVIDIA. Now, NVIDIA stock has been one of the main winners from the AI buzz. The stock is up almost 100% year to date. And also these family offices both increased their holdings of other tech names. Tepper invested a new position in Cathie Wood's ARC Innovation Fund. And then when it comes to Drunken Miller's Duquesne Fund, they've invested in Microsoft, who is the holder, or who's one of the big investors in OpenAI, who is the holder of ChatGPT. They've also invested in Google and some other healthcare AI names, and added to their U.S. big tech names as well. That's Uber, Amazon, and Meta. Clearly, these family offices are chasing this AI trade and are still very positive on big tech in the U.S.
All right, Valerie Teitel, thank you very much indeed for the latest on those hedge fund filings and that support, that money coming through for AI. Let's stay on the AI conversation and tech in particular then, and bring in Shmuel Chafetz, founder and chairman at Target Global, managing a pan-European tech investment firm with more than 3 billion euros in assets AUM. And to date, the business has backed about 13 unicorns and 7 IPOs, including the likes of Delivery Hero and Revolut. Not an IPO for Revolut, but backing and certainly part of the portfolio. Shmuel, thank you for joining us in the studio.
Not yet, at least.
Not yet, at least. Maybe we can push you on the time frame for Revolut's IPO. But let's start with the AI question and how you differentiate the hype with the AI that is actually going to create real-world benefits. How are you looking at that?
First of all, benefits an interesting question, right? It will create benefits and some big problems. I think it's pretty easy to overestimate the short-term impact of innovation and to underestimate the long-term impact. And that's, I think, something that recurs in our industry, right? If you look at, for instance, autonomous driving, 5-6 years ago, the huge hype, the hopes, the IPOs, the SPACs, the big money. We're not seeing autonomous cars down the street, maybe in San Francisco somewhere, but you're not seeing it yet. It's a huge technical problem to get from that 80-90% that we've gotten to the 100%, 99% to something that can really be out there. That's a huge technical problem, and the same thing I think holds true for generative AI. It is an amazing piece of technology. It's still nascent. Yeah. It's still something that even the people who create don't understand.
Well, I feel like, I understand, that some of the earlier technology, it took a long time to adopt, like even the browser and the web, but this is changing everything like now. I mean, I know kids that are not even going on Google anymore because they just put in, ChatGPT. So where are we going to be in 6 months and 9 months? Is there a worry that we're going to be overrun, actually, by how fast this thing takes over?
I think that, again, we're overestimating how mature this technology is. I think we're overestimating how mature ChatGPT is, how truly, of course, the consumer applications of it, the kids looking into things on chat, that's going to happen faster. But the ability to put it in mission-critical systems in healthcare, in business applications, in financial services, that's quite far away. I think that's still...
What's far away, 2 years?
It's, if I only knew, right? But I think it could be a decade. It could be, there's going to be an adoption curve. It's going to come. It's going to be... I think first, there's going to be a lot of co-piloting happening. I think Microsoft's doing it with Excel. It's going to be amazing co-piloting applications. I think we're very excited, for instance, about the possibility of taking things in a company and actually using AI to get smaller number of people with deeper know-how into a process. So, for instance, for customer support, right, you can put a lot of it in the hands of an AI, but put a small number of people who have, deep understanding of what you need and really can help the customer. And just freeing up time, freeing up money. I think there's a lot you could do. There's a lot that's going to happen over the next 10 years. The thing that again, would happen, I think, quicker is, much like the cloud, AI will enable people to build things faster. You'll be able to start up faster. It'll restart the cycle of innovation, and that's very exciting. But still, we shouldn't overestimate what it's going to do in the short term.
So how are you investing along some of those themes? Are you sitting on the sidelines until you see more clarity, or are you starting to put money to play?
You can't sit on the sidelines at the end, but I think that we're looking a lot at enabling technology. So the data side, I think data integrity and the way that you get data and structure data and bring data into this process is super important, right? Because in the end, it's sort of a garbage in, garbage out type of thing. And to me, every software company is an AI company today. A software company that doesn't have an AI strategy is on the way to demise. So it's not investing in AI companies, it's making sure that every software company that we're invested in understands how it leverages AI to make its business faster, better, more cost efficient. That's like a cloud strategy.
What does that mean, Shmuel? So what exactly are you looking at in terms of, if you target it, are there targeted pieces of this ecosystem that look like good value right now?
I think everything that's an enabler looks like good value. So something like NVIDIA, that to me looks like good value because it's pretty clear. I think companies that have a clear strategy around how they leverage AI for their core product, so enterprise software companies have a clear strategy, that to me looks like good value. I'm a little skeptical about sort of the level one, right? The ChatGPTs, OpenAIs. Again, they're brilliant businesses or brilliant technology companies. They still don't have a proven business model. They still have, it's still a question of where the value in this industry is going to lie. Is it going to be in some, ubiquitous protocol that everybody's going to use? Or is it going to be everyone's going to have their own model and that's going to be the proprietary piece of this industry?
Talk to us more broadly about the funding environment now for startups. We've seen job cuts, we've seen down rounds, we've seen some closures and collapses. How bad is it out there, Shmuel?
It's pretty bad. I mean, I've been doing this for 15 years, a bit more, and it's definitely the worst I've seen, including 08, 09. And I think it's the worst because of the unclarity, right? There's so many moving pieces, macro, there's this reshaping of the industry that's happening right now where, pricing was completely broken. Everybody were having, obviously an amazing time in 21. And 22, they started understanding maybe they weren't having as amazing time as they thought. Everybody made a lot of mistakes. And right now, it's just, I think the industry is in some sort of stasis. So it's very hard to do price discovery in our world anyway, without a market maker, without a transparent market. And right now, nobody wants to do that price discovery. From the company side, of course, nobody wants to test his pricing if they can avoid it. And from VC side, nobody wants to misprice another asset after 21. So nobody wants to misprice another asset. However, right, everybody in this, we get paid to deploy money, not to sit on money. That's the truth of this industry, right? And it's going to have to change. Right. So I think it will take another quarter, another two. Things will restart. People will restart testing that funding, where the price closes, and we'll see deals closing again.
Is this because of the ecosystem, or is this also just because of the banking crisis? So the fact that SVB went under, there's not, I guess, a more natural place for the ecosystem to flourish.
I wouldn't overestimate how impactful SVB was in the industry, right? In the end, we had a very stressful weekend where we started, I think a lot of people in our industry, for the first time, started thinking about treasury management. We're starting to look now at treasury management companies, right? I think it's a super interesting place to be right now. But, obviously the bank worked on Monday morning, the Fed stepped in, the Bank of England stepped in, everything worked, nobody lost any money. They kept lending. So in reality, it didn't have much impact. Everything that's happening in the macro, from interest rates to and everything else, is impacting the mood. Right. And we're in an industry where optimism is everything. So we invest in money-losing companies in sort of the far future. Right. So optimism is everything, and right now it's very hard for people to be optimistic. And that's the problem that we're facing.
And you see it reflecting. Thank you so much, Shmuel Chaffetz, there, founder and chairman at Target Global. Coming up, European finance ministers gather in Brussels as the Eurozone's inflation outlook is also raised. We'll bring you the latest, and this is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. Even though that that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Welcome back to the Open. 44 minutes into the European trading day. You're flat across these European equities. Futures in the US on the S&P E-minis in similar state. Nasdaq futures, though, pointing to a modest gain of about 1/10% as we weigh up, of course, the meeting that's expected on the debt ceiling in DC later today. A bit more action, though, in the gilt markets, with the yields down by about 7 basis points at the front end on the back of a bit of a mixed picture when it comes to wage growth and jobless claims here in the UK and what it means for the BOE. Now, Morgan Stanley is said to be considering a 7% cut in its Asia-Pacific investment banking workforce, with China taking the biggest hit. Stefania Bianchi, our senior finance editor in Dubai, joins us for the details. Stefania, what have we been hearing then about the Morgan Stanley job cuts in Asia? It doesn't seem that long ago that Western banks, Wall Street banks, were clamoring to expand their footprint in Shanghai and Beijing. Now there's this reversal.
Yeah, that's right. Just a couple of years ago, everyone we used to speak to was expanding there, but already now it seems they're retreating. Now, as you say, Morgan Stanley cutting about 7% of their workforce, so that represents about 40 positions. We understand that it's mainly going to affect the capital markets unit and those looking particularly at China deals. Already, they've axed about 50 jobs in that region last year. So really, it is just a case of more bad news coming after that. And what's particularly interesting about Morgan Stanley is that they seem to have a bigger team focusing on China, their rivals. So they are really more impacted by any plunge in deal making than their competitors.
So, Stefania, what is UBS doing in the US?
So UBS, as we know, they're going through this deal with Credit Suisse, and it looks like they're getting ready to bulk up in the US. They hired some bankers last month, I think it was, from Barclays. And again, we're hearing that they're hiring about half a dozen technology, media, and telecommunications bankers from Barclays. And these bankers are located in places like New York, San Francisco, and Chicago. So it really does look like UBS is taking this opportunity to really get itself positioned for the US market. So we're probably likely to see more of this in the coming months.
Stefania, thank you so much. Stefania Bianchi, they're a senior finance editor in Dubai. Now, European finance ministers are also in Brussels today. That's after the European Commission raised its inflation outlook for the euro area for this year and next, while pointing to a resilient economy. Let's bring in Bloomberg's Maria Tadeo in Brussels. So, Maria, growth better than expected. Inflation is still a serious headache.
Yes, Francine, and I think that's a very good way to put it. When you look at the overall picture, you do see that the European economy is still pulling ahead. When you look at the jobs market, it is still strong. Some say the resilience of the European consumer in this context of high inflation is also, to some extent, remarkable. But when you look at inflation, Francine, you had a double revision up for this year, 5.8%, and next year is 2.5%. So again, that's another big revision, 2.8% next year from 2.5%. Overall, that's the biggest concern for finance ministers here, who say ultimately for the consumer, this is becoming a headache. Politically, too, it is difficult to manage because, as you know, there is now a big election cycle that's kicking off in Europe with the big Greek elections, but also moving into the European elections next year. So a lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story. What they say is fiscal restraint should be top of the list and in order here. But a lot of this feels the job comes down to the central bank.
There are clearly some signs that the inflationary dynamic is beginning to change. From an overall level, it's moderating downwards from where we were a year ago, but inside that inflation, we're still seeing core inflation at too high a level. And I do believe that across 2023 and 2024, the ECB and governments can take the steps that are needed to get inflation back down to a level that it will not be the challenge that it is today for living standards and for the ability of households and businesses to trade and live.
And that was Pascal Donoghue, the head of the Eurogroup, speaking to Bloomberg exclusively yesterday. Say, well, trust on the European Central Bank. They have to do their job. But again, this inflation headache is not going away for policymakers anytime soon. I mean, that was the clear message yesterday.
Okay, Bloomberg's Europe correspondent Maria today on the ground in Brussels, of course, on the inflation headache for these Eurozone leaders. Thank you. Coming up, US House Speaker Kevin McCarthy says debt ceiling talks are, quote, nowhere near a resolution. We bring you the latest. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Welcome back to the Open, everyone. 52 minutes into European trading day. We're seeing a bit of a reversal with the DAX actually gaining some 0.3%. European stocks, but also U.S. equity futures now on the up. They were just 5 minutes ago down. A lot of the focus, of course, is on another round of talks when it comes to the debt ceiling aimed at ending the debt ceiling stalemate in Washington. That should be a little bit later today. Now let's take a look at some of the key things that markets are watching out for. 10 a.m. UK time, we'll get the German ZEW investor sentiment survey from May. Last month's reading showed outlook unexpectedly declining. At the same time, we're due to get preliminary readings of first quarter euro area GDP. 1:30 p.m. UK time, Canadian CPI data will be published. Also at 1:30, we're getting U.S. retail sales. And then a little bit later, 3 p.m. UK time, Fed Vice Chair for Supervision, Michael Barr, will testify before the House Financial Services Committee. Now, this is important because Barr has been leading a review of the supervision and regulation of Silicon Valley Bank in light of its collapse.
Okay, let's get a roundup of the first word news now in terms of what is happening, particularly in those debt talks. Janet Yellen, who of course spoke to Bloomberg earlier in the week, saying that the US is already paying a price for its failure to raise the debt limit. In a letter to lawmakers, she cited rising borrowing costs for government securities maturing in early June. Yellen also reiterated her warning the Treasury could run out of cash as soon as June the 1st. House Speaker Kevin McCarthy, meanwhile, says the two sides are nowhere near a deal on the debt ceiling. Turkey is set for a runoff election, with President Erdogan falling just short of enough votes for a first-round victory. Erdogan won 49.5% of the vote, with the main opposition challenger gaining just under 45%. The need for a runoff election to be held on May 28th suggests a more divided electorate than in 2018, when Erdogan won in the first round. Elon Musk has responded to news that he was subpoenaed by the US Virgin Islands in the JP Morgan Epstein lawsuit. In a court filing, the US territory said it had reason to believe Epstein referred or attempted to refer Musk to JP Morgan as a client. In a tweet, Musk said the notion that he would listen to financial advice from Epstein was, quote, absurd, adding that he never advised him on anything. The US is preparing to buy up to 3 million barrels of crude oil to refill its strategic petroleum reserves. The country's emergency stockpile is at the lowest level since 1983, after the release of over 200 million barrels to curb high energy prices last year. Deliveries into the government reserve are planned for August, with contracts to be announced in June. Okay, that is your Bloomberg First Word Roundup news. Let's get more on the debt ceiling debate then. House Speaker Kevin McCarthy says talks to avert an historic US default are, quote, nowhere near a conclusion. Meanwhile, as we mentioned, Janet Yellen, of course, the Treasury Secretary, warning that the government already is paying a price for failing to raise the debt limit. Bill Ferries joins us for the latest. Bill, what are the prospects then for a breakthrough today?
Well, as you said, House Speaker Kevin McCarthy has said that the staff level talks have been going nowhere. This is ahead of his planned meeting later today at the White House with President Biden. It gives them another chance to try to find some common ground and get their staffers working again on talks ahead of what could be as soon as a June 1st deadline for the debt ceiling to get raised.
So, Bill, have the two sides made any progress so far? How long can this actually go on for?
Well, I guess there's been some progress if you consider that the Democrats' original position was that there would be no negotiating at all. They are sitting down. They do have their staff working with Republicans. But so far, both sides are offering proposals that the other side considers unacceptable. For the Republicans, Democrats are proposing some closing some tax loopholes. Republicans see that as a tax increase and aren't willing to go there. Republicans are proposing limits on some kind of aid for poorer people. Democrats don't want to touch that.
Bill, thank you so much. Bill Ferries there on the debt ceiling. Plenty more on the markets with Surveillance Early Edition next. This is Bloomberg. you're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it's very different, and it's not something people have had to operate in for a long time.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. China's consumer spending and industrial activity disappoint in April, calling into question the strength of the economic recovery. Debt talks in Washington. Treasury Secretary Yellen says the U.S. is already paying a price for the stalemate. Plus, sterling drops on signs that the UK labour market may be starting to cool, even as wage growth accelerated again in the first quarter. Well, good morning, everyone. Let's check in on the markets. A lot going on as we saw a little bit of a reversal. British pound firmly in focus. Some of the other things that we're watching out for is, of course, equities in general. Now, we did see a bit of a reversal because we saw some pressure, and now we're seeing a bit more of a catch-up. Certainly the DAX now gaining 0.2%. We had the Japanese stocks rally and pound weaker, so we'll have a full roundup of some of the UK news. Oil demand will rise more than expected on the rebound from China. We're just getting some breaking news out of the IEA. This, of course, not only could move the price of oil, but it could also have an impact on what dollar does. Oil demand, again, they're expecting it to rise more than expected. This is their annual report. They're expecting world fuel consumption to increase by 2.2 million barrels a day in 2023. And if you understand what the agency is also predicting, they believe that as demand accelerates and the OPEC Plus alliance led by Saudi Arabia curbs supplies, then you could see global oil markets actually remaining on track to tighten sharply in the second half of the year. You can see for the moment, crude oil, NYMEX 71.46, and crude here at Brent, the London market, $75.63. Now, in a couple of minutes, we'll also speak exclusively to the IEA's head of oil markets, Toril Bozzoni. Then, fresh data out of China suggests that recovery in the world's second largest economy is losing momentum, although we saw a bit of a mixed signal. Consumer spending and industrial activity grew at a slower pace than expected in April. The youth unemployment rate also surged to a record high of just over 20%. Well, we're now joined by JP Morgan Chase Global Rates Portfolio Manager Kim Hutchinson. Kim, great to have you on the program today. There's a lot going on, what we're expecting actually inflation to do, and in general what the markets are pricing in. What's the biggest unknown right now, what the Fed does?
For the Fed? So I think what the Fed told us that May was their last hike. Their game plan from here is really to pause and wait and see for the rest of the year. They removed the implicit hiking bias. They told us that policy rates are currently restrictive. They are causing credit conditions to deteriorate. Powell, even without looking for a recession this year, also told us that we're basically nearly there, if not already there. So we think May was their last hike.
So we looked at the last 7 hiking cycles as well, going back to the 1980s. You know, how long did that take from the Fed's last hike to their first cut? That on average was 6 to 7 months.
Yeah.
So if May was the last hike, that takes us to the end of this year. We do think there is some reason to believe that it could be quicker this time, just because of the sheer pace and magnitude of the hiking cycle.
But, okay, so we just have this IEA saying, look, oil demand will rise more than expected on the China rebound. When you look at also what the market is pricing in with, for example, the Fed cuts, which a lot of people are pushing back and saying, look, it's just too soon to see cuts this year. Does a rebound in China, you know, fall into that equation that we could still possibly avoid a recession?
I think what we saw from the China data this morning is that it is softening. Chinese government bond markets priced a lot of that in already coming into April. So we didn't see a big move there. But you know, we know that this growth story in China that's coming this time, it is very consumer services led, which is domestic. So the spillovers are smaller into the rest of the world. So we don't think that's going to be a big driver in terms of whether we go into a recession in the US or not. It's more going to be the domestic growth and inflation data there.
So how do you construct a portfolio in this kind of environment?
Yeah, so the markets have really been coiling in the last month, not doing that much. As you mentioned earlier, there's a lot of cuts already priced in for the Fed as soon as July. We think a cut could come as soon as September instead. But you still got to be in those end of cycle trades. So looking for lower yields, steeper curves, high quality duration. You know, May was probably the Fed's last hike, and history tells us to buy the last hike. We like owning duration in the US the most. You get the added tailwinds that you come from tensions around the debt ceiling that's still ongoing, regional banking stress that could reemerge. So we still like duration. I think the way you square that circle with being afraid that the data is going to be a bit stronger near term and pushing those cuts further out is just to own more duration in the belly of the curve.
So when you look at, is that across the board? Is that in the US? I don't know if you look region by region and whether you make differentiations.
Yeah, so we do like US duration the most, but the UK market is one that we're actually thinking is starting to look quite attractive from a valuations perspective as well. So it's a good diversifier in your portfolio. Inflation is still very persistent. It's probably got one of the most persistent inflation problems among the developed markets, but those valuations have also repriced significantly this year. We like to look at, for example, where the 10-year UK yield is trading versus Germany and the US. And that spread is at levels that we haven't seen since 1997, putting aside the trust period that we saw. So I think that's a good long duration diversifier to start edging into.
Yeah, Kim, when you look at the UK, and I don't know how actually, you know, concretely, apart from how you just say you play the UK and what you make of the data out today, like if we start seeing quite a big hit on the labor market, how does that change your equation?
Yeah, so I think it's important to put some context around that. Last week, we saw the Bank of England give us hawkish forecasts. They really shifted up their growth and inflation forecast. They kept their tightening bias intact. But then the communication and the press conferences after were also a lot more dovish. And if we look at the labor market report today, we did see tentative loosening in the labor market, which is good news for the bank, but wages are still at 7%. Participation rate did tick up, but now we're left with the highest number of people who are out of the workforce because of long-term illness. We know those people aren't coming back that soon. So you could argue that the participation rate has probably reached its limit in terms of how much it can rise significantly in the near term. So I think the Bank of England's still stuck. You know, there's still more data to chew before the June. You get one more labor market print, 2 more inflation prints. So we'll have to see how that data develops. We do think there's going to be enough inflation fuel in the tank for the BOE to still keep their foot on the pedal and give us some more hikes.
So where do we end up by year end?
Yeah, it's a good question. I think they're going to give us 2 more hikes to get to a 5% terminal rate. There could still be a lot of strength in the UK economy over the summer. When they hit 5%, they can then pause, take a look at the data. And then, of course, it depends as well what the Fed is doing in the tail end of this year.
Kim, when you look at the Bank of Japan, and this is probably the most interesting financial experiment of all times, I mean, do you see value, or are we still in a wait-and-see situation because we don't 100% know what the governor will do and whether he'll be able to do what he's announced?
Yeah, so I think the inflation narrative is definitely changing in Japan, and the Bank of Japan is taking note of that. They are talking about upside risk to inflation. So you've got core at about 3.8%, and the breadth of those pressures are also broadening, which is important. However, we don't think rate hikes are a story for this year.
Them letting go of yield curve control policy, though, probably is, which is why we still like to sit short tenured Japanese government bonds, just on that chance that they will release that this year.
All right, wonderful. Thank you so much for joining us. That was JP Morgan Chase Global Rates Portfolio Manager Kim Hutchinson with the very latest on the markets. Now, coming up, an exclusive interview with the IEA's Toril Bozzoni on their latest oil market report. That's coming up shortly, and this is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, global oil demand will climb more strongly than expected this year. That's the view of the International Energy Agency. It says world fuel consumption will rise by 2.2 million barrels a day, helped by China's post-pandemic rebound. Now we can speak to the head of the IEA's oil market division, Toril Bozzoni. Toril, as always, thank you so much for giving us a little bit of your busy schedule. Now, if you look at the stronger demand or the stronger demand growth that you're seeing in the report, I know that's also from a weaker assessment of previous years. So overall, how would you describe the report? Is it as strong and bullish as maybe some of the places in the markets are taking it?
Yeah, good morning. Yes, what we're seeing is we're really seeing really strong demand, especially in Asia at the start of the year. Chinese recovery has been faster and stronger than expected. And in March, Chinese demand reached an all-time high. Indian demand is also very robust, and we're seeing very strong growth also in the Middle East. And this is contrasting with the sort of the economic gloom and the concerns that we're seeing for the world economy from industrial activity, and especially in the OECD, where demand has been relatively weak over the past quarters. But we are expecting strong growth this year. In the context where supply is set to fall through the rest of the year, that might again put the market and prices under pressure.
We also saw a bit of weaker Chinese indicators. Would you say that risks are, though, to the downside?
Yeah, so as you said, a lot of the indicators for China, especially on manufacturing and industrial activity, has come in weaker than expected in contractionary terms. But we're seeing for personal mobility, the service sector is holding up strongly, not just in China, but globally. pushing up gasoline demand, jet fuel demand. The recovery continues. So there's a two-tier markets on the demand side that we're seeing, and obviously concerned about the relative weakness in manufacturing and industry, if that would translate into lower GDP than forecast for the remainder of the year and actually push down demand growth compared to expectations.
Given all the economic headwinds out there, are you still confident actually that the market will tighten pretty significantly in the second half of the year?
So we're obviously watching very carefully. The economic picture has deteriorated. Interest rates remain high and rising. Inflation is running high. And there is concern that we are going into contractions in many areas. But we're looking from the low baseline of last year when Chinese demand was contracting due to the restrictions that were in place, when aviation and travel was still constrained. We are expecting demand, but we're expecting very little demand growth in the OECD. For instance, in 2023, the OECD, so including the US, the Eurozone, Japan, Korea, is growing only by about 350,000 barrels a day, and that's in stark contrast with about 1.9 million that we're expecting for the non-OECD countries. So it's a market of two halves, if you can put it that way. But we are expecting demand to continue to recover.
Joel, when you look at supply cuts that were put in place by OPEC+, there was a big concern that this will bolster prices and hurt consumers. That hasn't really happened. With hindsight, did OPEC+ actually do the right thing?
Well, those cuts haven't really taken effect yet. They're coming into the market starting from May. But already in April, we saw oil supply fall. There was significant losses from Iraq, from Nigeria, from Brazil, other countries. But this is also coming at a time when seasonally refinery activity is weak and demand is weak in between the winter and the summer season. So it would be interesting to see now when further supply cuts starting this month, not just from some of the OPEC+ countries, but also from Canada, where wildfires are shutting in production. And you have the seasonal ramp up both in refining demand and in driving demand in the Northern Hemisphere, how the market would rebalance. And if we do see renewed inventory draws starting this month and the next.
OPEC+, I think, are meeting again at the beginning of next month to try and review production. What's your message to them now?
OPEC decision is obviously for them to see, but we're also watching carefully the market and how things are rebalancing. There is a lot of uncertainty out there, not just about the pace of oil demand, but the global economy. But I think OPEC+ meets at monthly levels, monthly meetings. So obviously, we've seen that they're adjusting their production regular basis. So if the market tightens, we hope that they adjust their forecast or their ceilings as needed.
Toril, in your report, you also talk about the dip in refining margins globally. Is that going to impact demand for oil worldwide?
What we saw a very sharp contraction in margins indeed, and that's led by the much lower diesel cracks. But what we saw is that a lot of refiners in Asia, both in China, India, that have access to discounted Russian crude, has been processing record rates during the first quarter at the start of the year. That has helped ease some of the tensions on the product markets. And so going forward, again, on the refining side, we're seeing activity shifting east, continued shift. There's new capacity starting up, but also those that have access to discounted Russian crudes have a better margins than the benchmark margins that we see elsewhere. But if we do see industrial activity and gas oil demand remaining weak, we could see some of the refining activity in Europe, also in the US, lower than earlier expected, and we have reduced our forecast for activity in those areas for the rest of the year.
Toral, thank you so much. Toral Bozzoni, they're head of the IEA's oil market division with, of course, the report out this morning. Now, coming up, another warning from Treasury Secretary Janet Yellen on the debt ceiling deadlock after House Speaker Kevin McCarthy says they're nowhere near reaching a conclusion. We'll have plenty more on the debt ceiling debate shortly. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. China's consumer spending and industrial activity grew at a slower pace than expected in April, adding to signs the nation's economic recovery is losing momentum. Industrial production rose 5.6% from a year earlier, much lower than the near 11% expected by economists. China's youth unemployment rate also surged to a record high of 20.4%. Now, Turkey is set for a runoff election with President Erdogan falling just short of enough votes for a first-round victory. Erdogan won 49.5% of the vote, with the main opposition, a challenger, gaining just under 45%. The need for a runoff election to be held on the 28th of May suggests a more divided electorate than in 2018 when Erdogan won in the first round. Now, Elon Musk has responded to news that he was subpoenaed by the U.S. Virgin Islands and the J.P. Morgan Epstein lawsuit. lawsuit. In a court filing, the U.S. territory said it had reason to believe Epstein referred or attempted to refer Musk to J.P. Morgan as a client. In a tweet, Musk says the notion that he would listen to financial advice from Epstein was absurd, adding that he never advised him on anything. Global news powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Leanne, thank you so much. Now, Treasury Secretary Janet Yellen has warned that the U.S. is already paying a price for its failure to raise the debt limit. Negotiations resume later today, but the House Speaker, Kevin McCarthy, says talks to avert a historic U.S. default are nowhere near a conclusion. Now, let's speak to Bloomberg's Bill Ferries. Bill, thank you for joining us. So what are the chances of a breakthrough today? 0 or 2%?
I think it's slim when we're still a couple weeks away from what's believed to be the earliest deadline for the debt ceiling to be reached. But what Kevin McCarthy said in his letter was that the staff level talks that have been taking place over the last week or more have really not made any progress at all. This is the last chance for McCarthy and Biden to speak before the president is scheduled to leave on a trip to Asia on Wednesday. So I think both sides are going to see whether they can make enough progress to get the staff back working a little more effectively, with early June being still the expected the deadline, or when the debt ceiling will be reached.
So how much longer can this go on for?
Well, Janet Yellen, she's expected to give another update on when she thinks Treasury will reach that debt ceiling. We've heard it will be probably early June. It could be June 1st, but the reality of Capitol Hill politics is that any legislation to raise the debt ceiling would need to be moving through both houses several days before then. There are just some things that are very hard that are hard to speed up when it comes to writing and passing legislation, and the timeframes allowed for debate. So they need to, if June 1st were the date, they need to be having legislation moving perhaps 4 or 5 days before then.
Bill, I mean, are there any sticking points that they can actually work on, or is this going to be an 11th hour kind of agreement because the markets go crazy?
Well, when we've seen this in the past, and we've seen it many times in the past, it's always a last-minute agreement. The Republicans are trying to make some changes. They want to see some spending cuts. Democrats are proposing in return closing some tax loopholes. For Republicans, closing tax loopholes is seen as a tax increase on the people affected, and that for them is a red line. So both sides, although they're putting things forward, seem very far apart.
Bill, thanks so much. Bill Ferries there on the U.S. debt ceiling. In the meantime, we're also looking at some of the exceptional things we're seeing on the markets. Now, European stocks and U.S. equity futures, I think both declining now before this other round of talks in Washington aimed at ending the debt ceiling stalemate. Then we also have a renewed push by Japan's corporates to increase buybacks and focus on returns and helping boost sentiment in Asia. That's not quite translated here in Europe. Coming up, the latest data shows some tentative signs of weakness in the UK jobs market. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. know this like I know this. I got on a lot of planes. Even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate World Cup.
This is a 3 as the economic picture does.
The BOK is getting ready to make a decision.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
China's consumer spending and industrial activity disappoint in April, calling into question the strength of the economic recovery. U.S. futures fall ahead of more debt talk in Washington. Treasury Secretary Janet Yellen says the U.S. is already paying a price for the stalemate. And sterling drops on signs that the U.K. labour market may be starting to cool, even as wage growth accelerated again in the first quarter. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, UK wage growth accelerated in the first quarter, suggesting let-up in the inflation pressures worrying the Bank of England. Now, average earnings, excluding bonuses, rose 6.7% in the 3 months to March compared with a year earlier. Joining us now is our Bloomberg UK correspondent, Lizzie Burden. So, Lizzie, how have the BOE bets changed? If you look at the labour market, sure, it's softened, but if you look at what we're paying workers, it's still above 7%.
Yeah, so to break down the market reaction, as you say, BOE bets fell initially, and the pound fell against the euro and the dollar. Some of that fading since the release, but it seems that markets were really focusing on the payroll number. And economists say you really have to treat that with a big dollop of salt. It's usually subject to revisions. They also seem to have been reacting to the dovish commentary from Hugh Pill yesterday, the chief economist of the Bank of England, saying that he hopes the bank's near the end of its tightening cycle, and that's really the clearest sign yet that we are. But for economists, the commentary has been slightly different. They focus instead on inactivity falling. They say that, yes, unemployment was expected to hold steady, but it's ticked up. And wage growth, as you point out as well, wasn't as high as expected, but there is still an increase. So as the morning goes on, really, economists and markets converging, and the bottom line is the labour market is still tight, but it's showing signs of cooling.
So, Liz, what does this mean for the government?
I mean, we know that Rishi Sunak's #1 priority is halving inflation by the end of the year, so any sign that he could make that happen is going to be welcomed, not though that unemployment has ticked up. But the worrying number today for the government is that the number of people who are economically inactive because they're long-term sick is at a new record high. Now, of course, another of Rishi Sunak's top 5 priorities was cutting NHS waiting lists. And he's not going to be helped by the fact that another number in all of this is that the number of days lost to industrial action is climbed again. And that includes, of course, doctors and nurses. Now, we've already seen strikes weighing on GDP. This could be adding to the economic inactivity problem. So they all feed in together, and it really puts pressure on the government to settle those strikes with the unions.
Lizzie, when you look at the labour market, and someone from JP Morgan was making actually that point about 20 minutes ago, because we understand that so many people have left the workforce because of long COVID or for various reasons, because of the pandemic, how difficult will it be to get them back in? So is the labour market still just structurally stuck in the UK?
I mean, this is the headache for the government at the moment, in particular Mel Stride, the Work and Pensions Secretary. So in the budget, they already did these childcare reforms, pension reforms. The good news is that you can see students coming back to the workforce. That's what's driving this reduction in economic inactivity. But in order to get the long-term sick back, you need to reduce the NHS waiting list, which is why I say that the doctors and nurses striking is a difficult problem. The other approach that the government may want to take is, you had Mel Stride saying that potentially they could cut income tax if people come back to the workforce. That wouldn't necessarily solve the same problems that childcare could, in the sense of closing the gender pay gap and growing the economy. So you have to ask, when money's tight, how does the government want to prioritise the way it's going to do this?
Yeah, and how do they grow? Lizzie, thank you so much. Lizzie Burden there, our UK correspondent. Now, Trader is also pricing in another 25 basis point hike at the next Bank of England meeting in June. The former governor, Mervyn King, says COVID and the war in Ukraine have thrown curveballs at the central bank. He says the BOE should not be making such precise forecasts.
The circumstances of a pandemic and what's been happening in Ukraine mean that it is foolish to try to pretend that one can forecast accurately. That's far too precise. We do not know enough about the future to make those forecasts. What we need to do is to identify risks.
Former Bank of England Governor Mervyn King there speaking to Guy Johnson. Now, the chief executive of the London Metal Exchange also says the resumption of nickel trading in Asia hours has pushed up in volume, but not back to the level before the crisis in March 2022. Matthew Chamberlain spoke to Bloomberg's David Inglis in Hong Kong.
27th of March, we reopened Asian hours trading for nickel after the nickel events of March last year. We're really pleased about that. You know, it's just nice to wake up in London, turn on my screen and see that there've been 500, 600 lots of nickel traded. And I think that's really indicative of how important this time zone, this geography is to our contracts. We're really pleased about that. And actually, if I look at nickel generally, April, which is our first month with the Asian hours reopened, volumes full month, full month, outright volumes up 10% on the prior month, 60% on the prior year. Obviously, that was just after the events of March. But it feels to me like we're building back.
What was pre-pandemic Asia hours nickel, just for context? I guess so. It's 50, 500, 600.
So you'd normally see over 1,000 pre-pandemic. So not back there yet, and not back there yet with the entire contract. But it's this process of rebuilding trust.
Well, I was going to get to that reputation. Do you think you've managed to salvage that completely? Like, that's an abstract concept, obviously. Where are you on that conversation?
We're very conscious that trust is something that takes a long time to build or to rebuild. But I would like to think that our market believes we're doing the right things here.
I want to start with OTC sort of transparency. How has that been received, over-the-counter sort of positions?
Yeah, so there's always going to be a tension here, because understandably banks don't want to reveal their OTC books. But I think there was a real feeling after March 2022 that as a community we needed to come together to stop this kind of thing happening again. And that's why we put in place the OTC reporting requirements. And I think people have taken them in the spirit that they're intended. We're not gathering that information for commercial purposes. We're not gathering it to try to bring it on exchange. We're gathering it purely so that our market surveillance colleague can have a comprehensive view of risk. So I'm really grateful that people have taken that, as I say, in the spirit it was intended, and I think it's working well.
Well, that's the Chief Executive of the London Metal Exchange, Matthew Chamberlain, speaking to our David Inglis in Hong Kong. Now, we'll be covering all things UK every week on Thursdays at 9:30 a.m. UK time. In our half-an-hour special this week, we're joined by one of the UK's most prominent financiers, Guy Hands. Coming up, billionaire bets, investing titans load up on AI stocks. We take a look at what's in and what's out from the latest 13F filings. That's next, and this is Bloomberg. you're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it is causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
The Fed coverage you're looking for. Today, an exclusive interview with Richmond Fed President Thomas Barkin.
Everybody's got a recession playbook, and the reason they haven't turned the pages is that their business actually remains pretty sound.
Then Bloomberg's Michael McKee speaks with Chicago Fed President Austin Goolsbee.
We should gather further data, and we should be extra careful about raising rates too aggressively.
The most in-depth coverage and analysis of the Fed, right here on Bloomberg, your global business authority.
Now, the latest 13F filings show Michael Burry, the money manager made famous in The Big Short, now has a big long when it comes to China. Now, for more, let's bring in Bloomberg's Valerie Teitel. Valerie, he basically fully loaded up on JD.com and Alibaba. Unexpected, frankly.
Yeah, well, so he's been building a position in Chinese equities since late last year around the China reopening narrative. But in the first quarter of this year, he has tripled his exposure to JD.com and doubled his exposure to Alibaba, taking China tech. 20% now of his 50 billion portfolio is now exposed to Chinese tech. And, as this tech trade heats up, there's a lot of discussion of whether U.S. is going to outperform Chinese tech. Michael Burry is clearly in the China camp. He only actually has one U.S. tech holding name, and that's Zoom. But it's really taken over by his massive holdings in these Chinese tech names, especially Alibaba and JD.com.
Yes, we love going through these 13F filings because it basically gives us an inside glimpse into what these big hedge funders are looking into. If you look at, AI is a big bet for almost everyone.
Yeah, so especially when it comes to the family office's name, that's David Tepper's Appaloosa and Drunken Miller's Duquesne. Both showed quite a sizable position building in AI names, one of them being NVIDIA. Both of those funds increased their exposure in the first quarter. And Tepper's fund made some new positions in Cathie Wood's ARK Innovation Fund. And then when it comes to Drunken Miller, he invested quite largely in Microsoft last quarter, who is an investor in OpenAI who holds ChatGPT. He also invested in a healthcare AI company and Alphabet. Those were of his new positions. But it seems like the NVIDIA holding that they're building, NVIDIA has been a stock that has gone up almost 100% in the first quarter. It's been really a beneficiary of this AI buzz. But, in these 13F filings, we only know their holdings at the end of the first quarter. So it's a bit unclear whether they're chasing the trade or hopefully they were in it from the beginning of Q1 and benefited from it.
Yeah, also unclear to me actually whether Burry, so he made his name as a contrarian, right? This is all, we know him because of 2008 and some of the bets that he took in subprime there. Is this because he's bullish on China, or he just thinks that the fears on China have been overdone?
Well, look, the fears on China have really only escalated in the past few weeks when the Chinese data has soured. If you go back and see when he initiated these positions, it was clearly just bullish on the China reopening narrative, which has been thrown a bit of cold water on when we've gotten some sour data like the data we got overnight from China. But he is a bit contrarian, especially when it comes to his holdings of U.S. regional banks. The 13F filings showed that he held First Republic, PacWest, and Western Alliance. Now that stands at a bit of a contrast to what we've heard from Warren Buffett, Berkshire Hathaway, who's kind of soured on the U.S. regional banks, and the 13F filings there showed that Berkshire actually exited their positions totally of BNY Mellon and U.S. Bancorp.
All right, thank you so much, Valerie Teitel there with the very latest on some of these 13F filings. Now, Fed rate hikes and negative social media sentiment helped cause Silicon Valley Bank's collapse. That's the view of the company's former chief executive officer. Greg Baker submitted the comments in writing ahead of a U.S. Senate Banking Committee hearing later today. Now, SVB was seized by regulators in March with its failure setting off a number of other bank runs. Well, Stefania Bianchi, our senior finance editor in Dubai, joins us now. So, Stefania, tell us a little bit more about what Greg Baker said.
That's right. As you say, Francine, he's saying that comparisons by the media between SVB and Silvergate Capital, which announced its plans to wind down just a few days before what happened with SVB, that they all contributed to its failure. And, you know, discussions and rumors online really led to this unprecedented bank run, which we now know led to its collapse.
So what is a wider impact of his written testimony?
Well, look, I think since the collapse of the likes of SVB and Silver Capital, executives have really been under pressure at these failed banks to really understand what went wrong. So I think people will be watching this hearing closely to really get more details of what went wrong and what could have been done to prevent these collapses and potentially any future collapses that may come in future months.
So, Stefania, what can we expect from today's committee hearing concretely?
So this is the first time that Becker will be speaking publicly since March the 10th, and that was when SVB was placed into receivership. So again, I guess we'll hear more details of what went wrong. But also there will be executives from Signature Bank. We'll have Scott Shea, the former chairman of Signature Bank, and other executives who will testify. And we already know from their written testimony that they believe that Signature Bank's liquidity position was actually, you know, it wasn't too bad. I mean, it should have actually allowed the bank to stay open. But at the same time, they're saying that they understand why regulators took the actions that they did. So it will be interesting to hear both sides of that argument.
Stefania, thank you so much. Stefania Bianchi there with the very latest, of course, on SVB. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Treasury Secretary Janet Yellen says the U.S. is already paying a price for its failure to raise the debt limit. In a letter to lawmakers, she cited rising borrowing costs for government securities maturing in early June. Yellen also reiterated her warning the Treasury could run out of cash as soon as the 1st of June. House Speaker Kevin McCarthy, meanwhile, says the two sides are nowhere near a deal on the debt ceiling. Now, Microsoft's takeover of games maker Activision Blizzard has won approval from the European Union, putting the bloc at odds with regulators in the UK and also in the US. The EU says the $69 billion deal is pro-competitive and would kickstart the market for cloud streaming games. Microsoft is mounting legal challenges to the rulings blocking the deal. The US is preparing to buy up to 3 million barrels of crude oil to refill its strategic petroleum reserve. The country's emergency stockpile is at its lowest level since 1983 after the release of over 200 million barrels to curb high energy prices. That was last year. Deliveries into the government reserve are planned for August, with contracts to be announced in June. Bloomberg has learned that Amgen's deal to buy Horizon Therapeutics is to be challenged by U.S. federal regulators. The Federal Trade Commission is expected to file a lawsuit later today to block the $27.8 billion biotechnology deal on fears it could hamper innovation and slow the pace of drug development. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Francine.
Thank you so much, Leanne. Coming up, we'll discuss the inflation headache facing European finance ministers as they meet for a second day. We'll be live in Brussels, and this is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
This is Bloomberg.
Look, in today's environment where there's so much uncertainty in the economy, I don't think we can really rule out anything. If I had to have a vote right now, I'd probably vote to hold. But as you noted, we got two more inflation readings. We have a jobs number, a jobs report that's got to come out. There's a lot more information we're going to have as to what's going on.
We at the Federal Reserve probably have more work to do on our end to try to bring inflation back down. And most importantly, we should not be fooled by a few months of positive data. You know, we still are well in excess of our 2% inflation target, and we need to finish the job.
Atlanta Fed President Raphael Bostic and Minneapolis Fed President Neil Kashkari on the U.S. Central Bank's next move to tackle inflation. Now, European finance ministers are meeting for a second day in Brussels. Let's bring in Bloomberg's Maria Tadeo from Brussels. So, Maria, good morning. Inflation, the biggest word for lawmakers. What can they actually do about it?
Yes, it is, Francine, because on the one hand, when you look at the economic projections that were released yesterday by the European Commission for the spring forecast, they do say the economy is pulling ahead more than expected. There has been real resilience in services, but when you look at inflation, the story is not over yet. And in fact, you had two upwards revisions for this year and next. And by the end of next year, you'd still have inflation, if you believe the forecast, at 2.8%. That means still above the European Central Bank target. Now, when we spoke to finance ministers, but also in particular the German finance minister, he sounded downbeat to some extent, repeating, yes, the economy may be doing better than expected, but the job when it comes to inflation, and this is a #1 issue, is not done yet. Let's take a look.
Price stability is our priority. And then we want to prevent severe economic downturns. And so we have to coordinate the monetary and the fiscal policies.
And that was Christian Lindner, the German finance minister, speaking here to reporters in Brussels just a few minutes ago. And Francine, in some ways, he also encapsulates this talking points that we've heard repeatedly from finance ministers. Now it's the idea to really take a sober look at fiscal policy, because you don't want to counter the actions of the central bank. There has been a real stress about this coordination between the fiscal policy and the monetary policy. We know the European Central Bank has asked for tailored fiscal policy at this point to rein back some of that stimulus. The IMF is also calling for it. The question is, how are European finance ministers going to deal with that? When you know that for a lot of people in Europe, they still say they feel that pain when they go to buy things on the supermarket, when they see it on their everyday lives and the cost of living over the past year.
Yeah, I'll say, I mean, it's very, very tough across the board. So that takes us to the ECB. What are the implications for policy?
Yes, and you know, Francine, we've already seen this downshift to 25 basis points. If you look to the future, obviously, there are a number of decisions that are coming up. You're looking at June 2. You listen and read the words of the Vice President of the European Central Bank, Luis de Guindos, on Saturday on the Italian media. He said, we've made that downshift. That is probably the new normal, so around 25 basis points, and we've entered the home run of monetary policy, perhaps suggesting and indicating that they have entered the next stage. But when you look at the market, they still predict there could be even 3 more hikes. Ultimately, you see that deposit rate that would peak at 3.75. And then, Francine, beyond that, and we talk about the lag between monetary policy, the actions taken by the central bank, and the feed through to the real economy, you see higher for longer, potentially no rate cuts until the back end of next year.
Maria, thanks so much. Bloomberg's European correspondent Maria Tadeo there in Brussels. Now let's also take a look at some of the key things that markets are watching out for today. 10 a.m. UK time, we'll get the German ZEW investor sentiment survey for May. Last month's reading showed outlook unexpectedly declining. Now, at the same time, we're due to get preliminary readings of first quarter Euro area GDP. 1:30 p.m. UK time, Canadian CPI data will be published. Also at 1:30, we're getting U.S. retail sales. And then later at 3 p.m. UK time, Fed Vice Chair for Supervision, Michael Barr, will testify before the House Financial Services Committee. This is important because Barr has been leading a review of the supervision and regulation of Silicon Valley Bank in light of its collapse. Now, coming up, we're joined by the Richmond Fed President, Tom Markin. That's also at 3:30 p.m. UK time. So that's going to be a fantastic interview, and we won't, of course, want to miss that. Oil demand will rise more than expected on the China rebound. That was our great interview with the IEA head of markets in terms of what that's doing to oil markets. Look, it has huge implications for what OPEC Plus could decide early next month when they talk about production cuts. Bloomberg Surveillance Early Edition continues in the next hour. Kriti Gupta in New York, Anna Edwards here in London, and this is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you would hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
From the world of politics politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
You think about where the economy was and where inflation was last summer compared to where it is today, we've seen really positive things happen.
We should not be fooled by a few months of positive data. You know, we still are well in excess of our 2% inflation target, and we need to finish the job.
It is foolish to try to pretend that one can forecast accurately. We do not know enough about the future to make those forecasts. What we need to do is to identify risks.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. China's recovery is quickly losing speed. That's leading to calls for more policy stimulus to boost growth. Not so great expectations. House Speaker Kevin McCarthy warns that the two sides are nowhere near a deal as he prepares to negotiate raising the debt limit with President Biden. And what's the latest 13F filings? What are they telling us about the U.S. economy? Two billionaires' family offices bet on artificial intelligence, while Berkshire Hathaway dumps regional banks and wagers on Capital One. Lots to digest this morning. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. Some fascinating news around. We follow the debt story, of course. We've got data crucially around the retail space from the United States later on, the strength of the consumer in focus. But markets overall not reflecting any of the excitement, I suppose, Kriti. Fairly stable.
Fairly stable. Look, it's a little bit of a litmus test today to see if that consumer momentum that really has been holding up the economy is still holding up the economy. Anna, you just talked about those headlines where you saw a lot of people saying, look, the Chinese data is slowing down a little bit. The debt data or the debt ceiling saga is ongoing with not really tangible progress. So nevertheless, futures are going to have a little bit of a negative bias right now, mostly unchanged. But that's really where the retail earnings could make or break the case for the U.S. stock market. So a little bit of a wait and hold pattern until we get those results starting as in less than 60 minutes. Anna, the two-year yield, though, continues to trade in that range as, again, we balance all of those different macro narratives. 398 on the two-year yield, already seeing a bid into treasuries, especially on the front end of the curve. That is a big deal when talking about where the direction of the dollar is going to go next, because once again, interest rates are now kicking back into the dollar story. It's not just a haven play anymore, and that's something we're going to talk with later in the show. The FX story continues to be front of mind as, we digest everything that's going on in Washington, both on the fiscal front and the monetary front as well. NYMEX crude, our classic recessionary gauge, that's what I'm going to call it now, 71 handle. And I think the theme for today is technical ranges not going anywhere until we have real catalysts. At least that's the macro story. A lot more going on the micro.
Right, let's have a look at where the macro story takes us here in Europe then. We've just had some data coming through on the German economy. The German May ZEW investor expectations falling to minus 10.7. The estimate was minus 5. So this is a survey of the expectations of the investment community, and it's moving in a more negative direction, more negative than had been expected as well. So certainly worth keeping that in mind as we look at what's happening in terms of appetite for risk assets. This is what we see on stocks right now. It was a fairly positive picture, but not moving much, actually. So there was quite a bit of green on that map, but only slight gains. This is the Vodafone share price, down by 4.2%. This is a company that is taking restructuring action, cutting 11,000 jobs, we've heard from the telecom giants here in the UK. They have businesses not just in the UK, though, outside in Germany and in Spain, notably, and that restructuring activity will take place across some of those areas. So we'll watch for further details there. A relatively new CEO, although she's been with the business for many, many years. Telecom Italia, also in the telecom space, that stock actually not moving all that much right now, but the stock has been in focus as a result of, and was weaker earlier on, because they've seen a bid from KKR. They'd also seen a bid from Macquarie and a state-backed business. That state-backed business and Macquarie have decided to step away from the bid for Telecom Italia, and so as a result, we are not seeing any more expectations of bid activity, and so the stock slumps. The pound is at 125.27, pretty flat against the US dollar. It really dropped earlier on. So a few hours ago, we got labour market data around the UK, and the wages picture actually a little bit more mixed. But in terms of the payrolls, the number of jobs in the UK and the way that is changing, that dropped by an amount we haven't seen for a very long time, and that spooked markets. The slowdown in the labour market in the UK then seeming to loom large on people's radars, and that really dropped the pound. But it has recovered. It's now flat against the US dollar. Brent crude in here as well, Chrissy. You had the WTI price. Here's Brent. We've got the SPR news flow, the Strategic Petroleum Reserves out of the United States, and also paying close attention to the growth story out of China. In the last hour on Bloomberg TV, our colleagues spoke to the IEA, and they were certainly talking about growth in China as a driver higher for oil prices.
Yeah, certainly something that we're still seeing, even though there are those macro concerns. You're not still seeing very much momentum, even a 0.3% gain, still not that significant. As we get a lot of those kind of signals from perhaps abroad, China, of course, is going to be part of that commodity story and the consumer story globally. In fact, their consumer spending and industrial activity grew at a much slower pace than expected in April, adding to concerns that growth in the world's second largest economy, well, might just be losing momentum. We're joined now by China economy and government editor Jill Deeses. Jill, walk us through the data we got today. What are we taking away from it?
Yes, well, I think that that's right, that this was a lot slower than expected. Remember that we were comparing this data in April to a year ago when Shanghai was in lockdown. So already there was a really weak base for comparison. And we didn't even see some of these numbers match those expectations. Industrial output grew at half the pace economists were expecting. Retail sales spiked 19-something%, but ultimately didn't really match expectations there either. We saw a bit of a slowdown in fixed investment growth in the first 4 months of the year. So all of this is just combining with a bunch of recent data that we've also gotten out of China, whether that be really, really sluggish imports, export growth that hasn't been as strong as we would have hoped. The housing market hasn't looked particularly great recently either. Looks like it's kind of losing some of that rebound momentum that we saw in the first 3 months of the year. All of this is sort of telling us that there are some pretty serious concerns about the state of the economic recovery and that sustainability going forward. And so what that ultimately might mean is that maybe the central bank, Chinese policymakers have to revisit whether there's additional support that they might need to pull forward. That could be a rate cut by the end of the year. There's a lot of different options that maybe we'll need to consider exploring here.
Yeah, absolutely. I wanted to ask you about that, Jill. How do policymakers respond then to this data set? All the three pieces of data we just showed on the screen were worse than had been expected. So how will the PBOC and others react?
Yeah, so I think that that's ultimately what economists are looking for. There might be that the PBOC has some room to cut policy interest rates in the coming months. Remember, the Fed is likely to pause their interest rate hike cycle as soon as June. So maybe that gives the PBOC a little bit more room there. But we've also talked to some other economists who are saying there could be other policy measures that need to be considered here. Maybe that comes into the form of like subsidies or other kind of fiscal stimulus that can stimulate demand there, because ultimately this comes down to business confidence and household confidence, which just really isn't there yet for this recovery to be sustainable.
Jill Deeses, creeping us on our toes, a crucial story in the China, even as we feel like in the last couple of years, perhaps we've started to see China and the U.S. on the economic front maybe diverge just a little bit, certainly folding back into the narrative. We thank you as always. Well, back on the economic front, sticking with that story, it's a busy week for U.S. retail as well. We're going to get Home Depot earnings before the opening bell today, plus retail sales data over at 8:30 a.m. Again, a litmus test for the broader economy. Bloomberg's Simone Foxman joins us now. Simone, walk us through what the economists are expecting when it comes to the data first.
Well, we do expect U.S. retail sales to have picked up in the month of April to 0.8% from last reading's negative 0.6%, but most of that is going to be on the back of auto sales and gas stations to some degree. So when you strip those things out, we're going to get a much weaker number, something like 0.2%. And when you look at all of this retail sales data adjusted for inflation, the consumer is spending less on goods than they were during the height of the pandemic, and that's especially clear on an inflation-adjusted basis. You know, I think we've seen consumers switch to spending on services generally. Their expectations for inflation are very high. We saw that in the New Michigan Consumer Sentiment Index. And this is maybe our first read a little bit on what is happening in the second quarter.
Yeah, absolutely. A really interesting first read. We also get a kickoff on the string of earnings that we're going to get from big box stores in the United States today with Home Depot. What are we looking for there, Simone?
Yeah, the interesting bit about Home Depot as well as Lowe's, which reports next week, and as you said, there's a string of earnings coming out, is that home improvement stores among the big box retailers have been seen as a bit of a defensive play. They were really hot during COVID because people were staying home, they were improving their homes, and now people are stuck in their homes with bank rate saying it's 30-year fixed rate mortgages at 6.9%. But we do expect to see some same-store sales slow down. That is the broad expectation from analysts. We expect to see some margins contract on the back of higher spending on employees. Goods remain pretty high, but volatility is possible here. We tend to see a big move on this stock. However, I think when we look ahead to the next 10 days, really, of these retail sales, we expect to see some weakness among consumers. We expect to see them shifting into lower tier brands, whether that's private label or just simply higher cost brands. And we expect to see consumers spending less on discretionary and more on staples. Does that mean they're shopping at Home Depot? That's kind of the outlook we're going to see today. In last quarter, I should say, executives there, including Ted Decker, were pretty negative on the outlook. So anything a little bit more positive would be an upside surprise.
A little bit of a low bar for Home Depot, if you will. Bloomberg Simone Foxman, we thank you, as always, for walking us through that story. Certainly tradable. Again, less than 60 minutes till we get those earning results. Also going to be big movers in the stock market, the result of the latest 13F filings showing billionaire investing titans Stanley Druckenmiller and David Tepper loaded up on stocks benefiting from the artificial intelligence boom during the first quarter. Charlie Bastick, our global finance correspondent, joins us now for the details. So AI, huh? What's so great about AI? Why'd they get in?
Yeah, we know that Stan Druckenmiller thinks about AI like it could be the next version of the internet in terms of the success through the next cycle. We also know that he believes that we are facing a hard landing ahead of us. That's according to remarks that Stan Druckenmiller made about last week over at the Sohn conference. Now, he increased his stake in NVIDIA. We know David Tepper of Appaloosa is also increasing his exposure to AI. When we look at Druckenmiller's holdings as a whole, though, I think it tells you a different picture about how he feels about stock picking as we head into that hard landing that he believes, selling out of 28 positions, adding 19 new ones. And so I think the net selling and buying pressure when you look at these big funds is very interesting. When you look at the whole community in aggregate on the heels of AI, as well as how we know technology is done overall, technology was actually the biggest sector increase among all of the 13F filings as collected and scoured by Bloomberg. And financials, no surprise, was the biggest sell. That is a big reversal from last year.
Right, and on that note, Shonali, very interesting, because so there's AI and technology on the one hand, then there's banks on the other, and financials. What do we know about Berkshire Hathaway and Warren Buffett's bets on the banking sector? He famously came to its rescue in 2008, at least in part. A more nuanced view, though, now of the regional banking turmoil.
Yeah, absolutely, much more nuanced view. And I would point out, Anna, that he has been kind of souring here on the banking sector really before we even saw a lot of these banking troubles bake in. Think about last year when he really cut his entire stake in Wells Fargo after betting on that bank for decades. Now he is going a little further here. We are watching him step back from the likes of BNY Mellon and US Bancorp. His increasing of the holdings of Capital One is very interesting here, Anna. And why is that? Because Capital One, we saw them really increase their provisions for loan losses very, very meaningfully here in the last quarter after they reported earnings. They're only down about 4% on the year. We had seen their stock really react to Berkshire's buy pre-market. you know, an antithesis to Berkshire here a little bit was Michael Burry, where he did add a lot of the regional banks, including First Republic in the first quarter. So you're seeing, you know, very big differences here between Berkshire's long-term play and some of the more opportunistic trading you're seeing from Scion over there.
Shanali, thanks very much. Bloomberg's Shanali Basak with the latest on financials. And coming up, we'll talk to Esther Reichelt, Commerzbank FX strategist. We'll get her take on the dollar with the debt ceiling conversation continuing. What does she think will drive the dollar in that context? We'll also talk about the pound, big loser earlier on in session today, recovered from those losses. And later today, we will have an exclusive interview with the Richmond Fed President Thomas Barkin and also hear from the Chicago Fed President Austin Goolsbee. We spoke with the Atlanta Fed President Raphael Bostic in an exclusive interview.
Look, in today's environment where there's so much uncertainty in the economy, I don't think we can really rule out anything. If I had to have a vote right now, I'd probably vote to hold. But as you noted, we got 2 more inflation readings. We have a jobs report that's got to come out. There's a lot more information we're going to have as to what's going on.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Focus on the technology, and in particular, the financial technology opportunities, because they're going to change the landscape in financial services over the next few years.
Bloomberg has the Fed coverage you're looking for. Today, an exclusive interview with Richmond Fed President Thomas Barkin.
Everybody's got a recession playbook, and the reason they haven't turned the pages is that their business actually remains pretty sound.
Then Bloomberg's Michael McKee speaks with Chicago Fed President Austin Goolsbee.
We should gather further data, and we should be extra careful about raising rates too aggressively.
The most in-depth coverage and analysis of the Fed, right here on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York alongside Anna Edwards in London. Look, it's all about retail sales data today and then the retail earnings themselves. These next 10 days are going to be crucial for the American economy and really to see if the consumer is still spending. Are they still holding their own even in the face of this persistent inflation? We're still at a 4.9% reading. That does not necessarily bode well for people whose disposable income is withering slowly, which brings me to this chart. For our radio audience, stick with me. Basically, we're looking at retail sales both on a nominal basis and then adjusted for inflation. Now, going all the way back to as far as the data goes, the lines go pretty similar. You see this kind of steady increase, a decrease during COVID, and then a big, big pop. But then it diverges. And here's what's so important about it, because on the surface, it kind of looks like, well, retail sales are actually growing. Maybe the consumer is spending more. That's this white line for our TV audience. But then when you adjust for inflation, that's where you start to see this gap, a little bit more of stagnant, all the way going back from June to 2021. And that stagnation is what's concerning. Although, I gotta say, on the surface, still good news, because even adjusted for inflation, consumers seem to be holding their own. There isn't that drop yet. Will we get that drop today? That's going to be the big question. Let's bring a little bit more market analysis to this conversation. Joining us now, Justina Lee, our Bloomberg Markets reporter. Justina, what do you make of this chart? For me, retail earnings are going to be that litmus test, but what else could shake this line?
Yeah, I think the question really here is how has consumer demand been affected by a year of monetary tightening? And I think that's going to be a really big question for people trying to read whether there's going to be a U.S. recession or not. Because on one hand, we're still seeing, slowing but pretty strong headline inflation number. But at the same time, we are expecting to see a bit of a kind of slowdown in retail sales. I mean, industrial production data today is expected to show a bit of a stagnation. And so I think the question for Fed officials here is really, do they think that a recession or like a contraction of that demand is going to come fast enough for them to not worry as much about inflation anymore? And kind of based on what we've been hearing so far is that, there are a few officials that say, okay, maybe we can pause right here. But maybe cuts this year have been too optimistic on markets' part.
Yes, we keep hearing from guests, Justina, who tell us that even if the markets are pricing it, they don't see the need for cuts. Not everybody, but we hear that often. I know that you've been thinking about the link between the markets and the debt ceiling fears, the way the markets will respond in the run-up to any X date. I've also been wondering about it the other way around, the role that markets play in focusing minds on getting a deal done. And if we did see a big move in markets, what would that bring to the table in Washington? What are your thoughts on the way that these two interplay?
Yeah, because if you look at markets right now, I mean, there are definitely pockets where you see anxiety of debt ceiling. I mean, most
Short
notably,
treasuries.
Exactly, yeah. Or like, the spreads of credit default swaps. I mean, that's actually for the U.S. above Greece or Brazil right now, which is pretty mind-boggling. And at the same time, there was a bit of a bump, in the T-bill curve. You see that the bills kind of that are expiring after the X date are kind of getting that bit of bump in premium. But I think kind of overall, markets are not panicking. I mean, if you look at the fact that stocks have been like sideways, but not really too anxious. And if you kind of think about kind of treasury yield. So I think if we really get more bad news on that part, I mean, that will definitely kind of weigh on markets further.
Justina, thank you very much. Bloomberg's Justina Lee with thoughts on the markets. And for market analysis, check out MLIV Go. That's the function to use on your Bloomberg terminal. That's where you find the Markets Live blog. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now.
You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. President Biden meets with House Speaker Kevin McCarthy and other congressional leaders today to try to avert a default. McCarthy says the leaders are nowhere near a deal to raise the debt limit. The standoff has been roiling markets as investors bet whether a deal can be reached. Elon Musk has been issued a subpoena by the U.S. Virgin Islands in a lawsuit over the late disgraced financier Jeffrey Epstein. Court papers say authorities had reason to believe that Epstein may have referred or attempted to refer Musk to J.P. Morgan as a client. Musk calls the idea, quote, idiotic. Wells Fargo agreed to pay $1 billion to settle a shareholder lawsuit. The plaintiffs accused the bank of making misleading statements about its compliance with federal consent orders. That was in the wake of the 2016 scandal over the opening of unauthorized customer accounts. Wells Fargo ended up paying $3 billion to settle the government probe. Bloomberg's learned that Morgan Stanley is considering a 7% cut in its Asia-Pacific investment banking workforce. More than 40 jobs are at risk. Deal-making has slowed down, especially in China, due to weaker economic growth and worsening relations with the United States. Anna, that continues to be a theme around the world, but the geopolitics, I think, is an interesting addition to just how discouraged perhaps a lot of these companies around the world, in Europe and America, are to actually enter not just Asia, but China specifically, which was making quite a bit of progress pre-COVID.
Right. I mean, this is a really interesting story, isn't it? Because it has that cyclical dimension around the Chinese growth story, but also the geopolitical dimension that you referenced, deteriorating relations between the US and China in the driving seat when it comes to this decision-making at Morgan Stanley. I should note that this is part of the 3,000 jobs that Morgan Stanley is cutting and that Bloomberg reported they are cutting earlier this month. So these aren't new numbers, but we're finding out a little bit more about the complexion of those job cuts, which I think is really important for those in the financial services sector. Now, coming up on the program, we'll talk FX. Chrissy, Esther Reichelt joins us, Commerzbank's FX strategist. We continue to look for developments around the debt ceiling. How will the dollar trade through all of that? A key question to tackle this week. We'll also ask about the pound, which has recovered somewhat from earlier losses. This is Bloomberg.
Forget a degree in finance. Go for a career in tech instead. That's the advice from the latest Bloomberg survey of professional and retail investors. Only 1 in 5 Wall Street professionals say high school seniors graduating this year should follow their footsteps and go into finance. About half say that Gen Z's best bet actually lies in the tech sector, and that's despite all those recent layoffs at companies like Meta, Amazon, and Google. Still, hiring trends paint a rosy picture for those with a background in tech. Industries ranging from auto to the federal government have jumped at the chance to recruit any laid-off tech workers. A degree in tech could set you up for a lot of potential jobs and a safety net if any of those jobs don't quite pan out the way that you'd hoped. Survey respondents also expressed concern about the long-term threat of AI. Think ChatGPT taking all of our jobs. For kids graduating from kindergarten this year, about 40% of investors said to go into healthcare. That way, when they come of age, they may be able to hedge against any potential AI-related job takeovers. Roughly 12% said Wall Street would be the right career given that pending AI threat. The AI concerns come despite traders themselves finding that current iterations of ChatGPT struggle with things like math and corporate earnings. But the idea here is that there's still plenty of time for AI to improve and to potentially threaten our jobs along the way.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. China's recovery is quickly losing speed. That's leading to calls for more policy stimulus to boost growth. Not so great expectations. House Speaker Kevin McCarthy warns that the two sides are nowhere near a deal as he prepares to negotiate raising the debt limit with President Biden. And what the latest 13F filings tell us about the U.S. economy, 2 billionaire families' offices bet on artificial intelligence, while Berkshire Hathaway dumps regional banks and wagers on Capital One. I'm Kriti Gupta in New York with Anna Edwards in London. Anna, a lot going on the macro front, even more going on the micro front as we kind of wait for some sort of direction from Washington, both on the debt ceiling saga, but also any developments that we're going to get from the G7. What it means for markets is a whole lot of nothing, it feels like. What are you seeing?
Yeah, certainly in a bit of a wait-and-see mode ahead of those debt conversations later and the data coming out of the US perhaps later on. Of course, the debt ceiling, the big talking point this week. The Stocks Europe 600 then, with that in mind, Kriti, going nowhere, as you mentioned, down by 0.1%. Most sectors have been in negative territory for this morning, although there have been some areas of brightness around technology, for example. Vodafone in the technology space is down by just over 4%. This is a business that under a fairly new CEO, she's been with the company a long time, but new in the CEO seat, is restructuring. They operate across Europe, not just in the UK, also Germany, Spain. They are announcing this morning 11,000 job cuts. Big restructuring exercise. The market unsure at the moment about some of the numbers as well, so the stock down over 4%. The pound is at 125.41, really recovering from being down 0.4% against the US dollar earlier on. We got this payrolls number that seemed to catch the market's attention in the way that it doesn't normally, distracted us from maybe the unemployment rate and the wages conversation, which were maybe more complicated and still suggested a tight labor market. But that payrolls drop substantially into negative territory really sent the pound dropping earlier on in trade. And Brent crude is down by 0.4%, also turning around some strengths of earlier on in the day. We've seen the strategic petroleum reserves narrative building in the US. They're topping up those stocks. That pushed the oil price a little bit higher, Chrissy. And so that's certainly something we're watching, as well as the Chinese growth story. What do you see in the US markets?
Yeah, I think it's a similar theme, Anna. The idea here that when you kind of similar to the pound, that nitpicking of data to just kind of get any incremental hint about where the economy is going, that's what's going to dominate markets in a market that, by the way, is doing a whole lot of nothing this morning. Futures are relatively unchanged. Really, again, waiting for that retail sales data and to start the retail earnings that we're going to get in, again, less than 30 minutes. Two-year yield, 397, just shy of that 4% level. Remember, we are seeing a small bid into the bond market early on into the session, and that's marginally taking the dollar with it. But again, that strength you're seeing in the pound is going to be pressuring the dollar just a little bit as well. 9 NYMEX crude, Anna, you hit at 74 handle on Brent. The spread between NYMEX and Brent is widening, though, so you are seeing a 70 handle on crude, down about 0.5%. I love to look at the commodities as a little bit of a risk gauge. If this is any indication of how futures are going to be trading later into the pre-market session, it's not necessarily looking good, Anna.
Yeah, okay, so oil prices down, futures a little bit softer. Let's talk FX, though. We're joined by Esther Reichelt, Commerzbank FX strategist. And Esther, give us your thoughts on how the dollar performs here, because, of course, the debt ceiling debate is the big subject in Washington. It is having an impact on some markets, not necessarily stocks, and arguably it is having an impact on treasuries. What is it doing to the dollar? What should it do to the dollar in various scenarios?
Well, that's a super interesting question, and I think this uncertainty about this question is what's currently driving the market. I mean, I guess everybody was a little bit surprised about the US dollar actually appreciating despite this US debt ceiling debate. I mean, there are some comments about this whole risk being priced out, looking at this low volatility levels and so on, but this does not really fit to the news flow we get. So, and I think it does more indicate that the market is actually leaning towards a stronger dollar, or to go in with a stronger dollar into this whole US debt ceiling uncertainty. Because there is a huge uncertainty about how markets will actually react if we might see a hypothetical default, because it's not about the US not being able to pay their debt, but rather about, like for political reasons, not wanting right now. And given this uncertainty about how markets react, it's always good to have the US dollar because it's a safe haven, it's one of the most liquid assets, and I think that's what we are actually seeing right now.
Esther, it's the no-brainer, it feels like, to do the dollar call, but I have to say, are you worried at all about becoming a crowded trade? I believe the Bank of America Fund Survey said that tech, shorting regional banks, and then at the end of the day, the dollar are the most crowded trades there are in the market right now. What would change your mind?
Well, absolutely. I mean, I'm very concerned that this US dollar strength we're right now seeing is just due to this whole, basically traders not knowing what to do. And this sentiment could shift very easily because the risks right now are clearly on the US dollar side. Concerns about regional banks' performance in the United States, this whole debt ceiling debate. This could easily shift against the US dollar. But right now, everybody's looking what everybody else is making, and the US dollar trades strong. This could easily shift with some more concrete negative news on the debt ceiling debate, maybe later today. But I guess the likelihood of this shift against the US dollar sentiment will increase the closer we get to this actually debt ceiling or default deadline.
Okay, yes, so we'll continue to monitor it and check in with you perhaps the closer we get to June 1st then, Esther, if these conversations continue. Stepping away from the dollar dynamic and to the pound, a few hours ago we got this data out of the UK labour market and the payrolls number, which isn't a number that seems to get a lot of attention from commentators usually and from economists, and yet that seems to be the thing that was driving weakness in the pound earlier on. The pound has recovered a little from that, or entirely recovered from that. I wonder what you make of that data set this morning.
Actually, this data today basically confirmed my view that, the market is expecting the Bank of England that the Bank of England wants to do a rate pause rather sooner than later. So any data indicating a cooling of the economy, they jump on, trade the pound weaker, pricing out interest rate hikes. However, it's pretty clear that inflation is still very high at the UK. Inflation risks continue. And I mean, if you look at the wage increases, they are still strong. So this still indicates that the Bank of England has to do more. So what we see is the Bank of England is rather reluctant, waiting for the possibility of a rate pause. But of course, nobody doubts that the Bank of England will do what is necessary if there are inflation risks. And this mixed data, therefore, was also reflected in a very mixed pound sterling performance. Everybody's shifting between, okay, so this is arguing for a rate pause, or rather, well, the Bank of England actually has to do more, which is, of course, then supporting the pound sterling again.
Esther, I want to go from the G10 story to the EM story and very casually avoid the pound as an EM currency joke that there is. I want to talk to you specifically about the lira here and whether or not, in the absence of any real direction from a lot of these G10 countries, where you are essentially navigating the same stories, inflation at the end of the day / debt ceiling, is there an extra incentive to perhaps take on a little bit more risk-taking into the EM FX world, perhaps a little bit more incentive incentive to trade a currency like the lira?
Oh, well, definitely not right now. I mean, we are heading towards runoff elections in Turkey. There was a huge disappointment by international investors, which had hoped for a more market-friendly government, and which does not seem to be the case right now. I guess for Turkey, actually, it's very difficult to trade it all. The exchange rate is still very steered, and there is a strong incentive of the Turkish government to keep it stable until the runoff elections. But it's also clear that there is a huge depreciation pressure. So Turkish lira basically seems like a one-sided trade, and it's difficult to get onto the other side.
Esther, very quickly, I want to talk to you. Actually, you know what? We're going to wrap it up there, but we thank you, as always, for joining us. We really appreciate it, really covering the gambit when it comes to FX and the story there. Esther Reichhold of Commerce Bank, we thank you, as always. Atlanta Fed President Raphael Bostic says he's starting to see the Fed's policies to fight inflation take hold, but not to rule out any more surprises. He sat down for an exclusive interview with Bloomberg's Michael McKee.
When I think about the trajectory of inflation, I think that we've made a really good progress on it. If you think about where the economy was and where inflation was last summer compared to where it is today, we've seen really positive things happen. We're not at the 9 and 10% levels. We're in 4.5 to 5 range. Now, look, that's still two times what our target is. So there's still a ways to go. But I do think that we've seen a lot of some of the froth really come out of the inflation measure. You know, one of the things I look at, one of the measures I try to keep track of, is the number of goods in the basket of this that's used to calculate the CPI that are showing inflation above 5%. Right now, in the latest report, that came under 50%. Less than half now are in that range, where at one point it was 70 or 80%. So I think we're seeing that breadth narrow, and that's a really positive sign. So I think we are starting to see our policies really work.
But do you rule out any more additional rate increases?
No, oh no. Look, in today's environment where there's so much uncertainty in the economy, I don't think we can really rule out anything. Look, I think we are in a place now where we've been in restrictive territory for something like 6 to 8 months. That's about the time you'd expect to see our policies start to bind on the economy. And when I talk to businesses, they tell me they're starting to feel that bind, and that's a really positive thing. But as you know, we've had surprise after surprise after surprise over the last few years, and most of them have been to the negative when it comes to getting closer to our inflation target. So I've got to keep that on the table for sure. But right now, I'm feeling like let's see how our restrictive policy is working, and that'll give me a sense of what our next move needs to be.
Well, you still have a PCE inflation report and a CPI.
We got 2 more, exactly.
Before your next meeting. What are you thinking now, though, for the June meeting?
Well, if I had to have a vote right now, I'd probably vote to hold. But as you noted, we got 2 more inflation readings. We have a jobs report that's got to come out. There's a lot more information we're going to have as to what's going on.
Atlanta Fed President Raphael Bostic speaking with Bloomberg's Michael McKee. Now, later today, we'll have an exclusive interview with the Richmond Fed President, Thomas Barkin, and also hear from the Chicago Fed President, Austin Goolsbee. Coming up on the program, Macron's EV pitch, how the French president is trying to convince Elon Musk that France is the next big place for Tesla. More next. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
how do you manage these kind of two different staffing needs, right? And making sure you have the right amount of people at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple of people, our average restaurant now does about over $1 million per restaurant in digital sales.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Chrissy Gupta in New York. Now, the French President Emmanuel Macron is looking to woo investors to the country with his Choose France event that's been taking place, turning on the charm offensive with Tesla CEO Elon Musk in the Élysée Palace on Monday. Macron is hoping to make northern France a hub for the production of electric car batteries. Bloomberg's Oliver Crook joins us now for more. And Oliver, you've of course been very close to the auto story across Europe. What did we get from that meeting that took place at the Elysée?
So apart from that pretty awkward video that you just showed, you got some sort of vague commitments. You had Elon Musk saying to Le Maire, actually, that he will probably make a significant investment in France at some point in the future. So from that standpoint, nothing terribly concrete apart from this sort of agreement. But, you can understand why France wants this. In Germany, Tesla employs 10 to 11,000 people. They have a Tesla factory just outside of Berlin. But this prompts a couple of questions. One, how will the French car makers react? Already, Tesla's blowing up the whole model for the auto industry and legacy automakers. And Musk, though, is someone with a rather sizable appetite for challenges. Is that appetite large enough to take on French labor laws? Musk is not exactly known for being someone that believes in a sort of work-life balance reputationally. And obviously, just a few weeks ago, you saw, Paris burning because Macron was trying to reform the labor market. So these are some of the questions, I think, going forward for it. But again, this is really part of Macron's bigger plan to attract more business. And again, it is still actually quite an attractive place for business if you look at the EY surveys in terms of attracting foreign investment. In Europe, it tops the chart.
How does that square then with this kind of massive push for the EV, the electrification process? Because he also was very vocal when it came to President Biden's Inflation Reduction Act and being competitive. How is this being received by his international peers?
So for Macron and for Europe more generally, you have this situation where Macron is talking about reindustrializing the economy. So the French economy is only about 9% industry. In Germany, that's close to 20%. And so you really, though it may not be the biggest companies, actually the biggest companies in Europe, as you know, is in France. It's LVMH. But its revenue is 30% dependent on China. So this is all about reducing dependencies from externally, but also creating, stimulating the economy that actually employs people. Volkswagen has more than 600,000 employees. LVMH is like around 100,000. So it's all about developing this and reindustrializing the economy. And he's walking a fine line, though, because he's talking a lot about we need to produce in Europe, we need to put Europe first. But the name of this event yesterday was Choose France, right? And he brought 200 business leaders and he got $13 billion worth of investment. But this is a bit of the line that you've got with the state aid rules rolling back, and it's going to be sort of a conflict for Europe going forward.
Okay, so he's talking to Musk. He's talking about Tesla. Tesla has feet in various parts of Europe already then, Oliver. What about the AGM that's taking place at Tesla today? What's going to be in focus there?
That's right. I think one of the main things that's going to be in focus is Musk's strategy that he's developed over the last couple of quarters of price cutting, of putting volume over margin. And this is a tactic that investors have not necessarily rewarded. And you saw it double down even yesterday. Yesterday in Germany, Tesla has cut prices additionally to those who are buying fleet large bulk Tesla. So right now for a Model 3, you get about 30% off for these fleet things with all of the subsidies and 25% off for the Model Ys. That's definitely going to be one of the questions. Investors are not necessarily convinced about the strategy, at least not all of them. You also had the story on Friday that was a bit buried. They had to recall basically all of their cars in China for a software update to deal with the braking. That's 1.1 million cars, so that may come up. But then again, there's also this question of, is Musk too distracted? So maybe the appointment of a new CEO at Twitter helps us out there, but there are already shareholders that are saying that they want a meeting with the board to discuss CEO Elon Musk's performance. So all of this to watch for the AGM later today.
Okay, we'll keep that in focus then in terms of the auto space. Thanks so much. Oliver Crook joining us there from Berlin. Coming up on the program, back to one of the things we talked about already, the strength or lack of for the US consumer. Home Depot is out with its earnings report shortly. We will get a preview next. This is Bloomberg.
The best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. And the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Let's get a look at some of the stocks we're watching in pre-market trading in the United States, starting off with Warren Buffett and the companies. Berkshire Hathaway has chosen to up their stake in HP and Capital One, already cashing the Buffett bid this morning. This is really important as we see Berkshire Hathaway kind of returning to a little bit of the old guard, dumping some of the regional banks, instead going to some of the classics. Capital One Financial, HP up about 1.5%, Capital One up about 6% as well. He's not the only investor we're keeping an eye on, though. Michael Burry getting his bets as well. This time, not in the States, though. It's abroad. Alibaba and JD.com, although both kind of dropping from that overnight Chinese data, they are on Michael Burry's radar, both dropping by the tune of about 1% and 0.6% respectively. You look at his portfolio, though, almost 20% of his portfolio is just those two names, Alibaba and JD. So he is getting that exposure to the Chinese internet story. That's going to be really important. As we talk about the tech story, let's talk about the tech story right back home, and specifically in biotech. Amgen right now, their $28 billion deal for Horizon Therapeutics, well, it's getting challenged by the FTC, and that is a really big steal in the biotech space. Amgen shares higher by 0.6%. Horizon, on the other hand, the target taking a little bit of a hit, down about 17% in the pre-market. But again, all eyes on those retail earnings. We are in the countdown to Home Depot reporting ahead of the opening bell today. Analysts warning their results may just show a little bit of pain, signs of weaker consumer spending. The shares are already down about 0.3% in the pre-market. Drew Redding, Bloomberg Intelligence analyst, joins us now on what to expect. Drew, thank you as always for waking up early. What is on your radar? What is the gauge of success for Home Depot?
Sure. So I think it's important to first point out that Home Depot has been on an amazing run the last couple of years, but we think that some of the tailwinds that they've benefited from during that time are starting to fade a little bit. And the most important one is the trends we're seeing with the consumer. So from the macro perspective, you have still high inflation, you have real wages, which has been pressured for the better part of a couple of years, and you've got credit card debt, which has started to explode. So it's kind of showing the pressure that the consumer has been under. But at the same time, at the company level, Home Depot's facing challenging comparisons. They've got commodity deflation. They're facing some weather-related challenges. And most importantly, and something that we're looking at for the remainder of the years, we think we're going to start to see more of a moderation in big-ticket spending. And that's really what's driven the home improvement retailers over the last year.
Drew, good morning to you. So we could see the weather having an impact here. We could see a pullback in consumers' enthusiasm for those big ticket items. What about conversations, though, around whether you move or improve? So if the housing market is looking difficult to navigate, you might decide to do improvements. Does that act as a bit of a buffer to a company like Home Depot?
Yeah, we certainly think that that has been a big driver of their success recently. They'll tell you that home improvement space has decoupled from its traditional relationship with housing turnover in the existing home market. Now, typically when you think of housing transactions, when you put your home on the market, and then, as soon as you make a purchase, you tend to fix them up. But because there's been such a lack of mobility in the market due to higher interest rates and generally weak affordability, we have seen people stay put and make investments in their home.
Drew, talk to us a little bit about the backlogs that we're seeing with same-store comps. And we're talking about these specific kind of metrics. Which one is going to be top of mind for you?
So certainly everybody's going to be looking at the trends in same-store sales. The consensus is for a low single-digit decline this quarter. We think that there could be some risk to that due to some of the factors we mentioned. But more importantly, I think there's risk for the full-year outlook. Home Depot guided to about flat same-store sales during their last call, and that outlook kind of assumes that the broader home improvement market declines only in the low single-digit range. And, when we look at our expectation for the market over the next year, we're kind of thinking that the market is down anywhere, from 5 to 7%. So we think that there is downside risk to the full-year outlook. And I think that's something that investors have been kind of latching onto, is that while you saw Lowe's be a little more cautious in their outlook, Home Depot has kind of maintained a little bit of that enthusiasm by keeping their comp guidance flat. So we do think there's some risk in that regard.
Drew, thank you very much. Drew Redding joining us there from Bloomberg Intelligence, and we'll certainly stay tuned for those numbers due from Home Depot imminently. That is it for early edition. Surveillance is up ahead. Tom, John and Lisa will be with you. They'll certainly be talking you through the corporate earnings stories as they come in. They'll be hearing from Tiffany Wilding, Chief Economist at PIMCO. They'll be getting a take on the U.S. consumer through those corporate earnings, but also the retail sales numbers. They are due later on today. That's the data point of the day. And, of course, building towards that debt conversation in Washington later on today. We'll see what comes of that, if anything. Do we have to get closer to X date to see any progress? Stay with us. This is Bloomberg.
most fascinating entrepreneurs because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably couldn't spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, of the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who, making things is important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
Concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg.
I'm leaning towards the bond market view that we're in for some volatility.
We're kind of bouncing into a ceiling and a floor, effectively.
We think the market's a little bit generous in terms of Fed cuts coming.
The Fed has done a very good job of continuing to support the economy while raising rates and trying to tame inflation.
I'm in the camp that it's not going to go neatly back to 2%. I think there's another upside surprise waiting out there in the inflation data.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Equity futures just a little bit softer. Here's the top line from Secretary Yellen this morning. TK, you'll love this one. Time's running out for the debt ceiling conversation.
I thought it was going to be the Boston Red Sox. It's day by day, tick by tick, and we're going to stagger towards where something actually gets done. I believe there's a meeting today.
There is.
Is that like the first, we moved from Secretary Yellen forward to an actual meeting with actual substance where they'll say, wait for Wednesday.
Speaker McCarthy and the President of the United States coming up a little bit later.
Yes.
Compare and contrast this. From Brainerd over the weekend, the National Economic Council Director saying the staff are very engaged. I'd characterize the engagement as serious, constructive. Speaker McCarthy says this. You'll love this, Lisa. Goes on to say, we're nowhere near reaching a conclusion. He found that ongoing staff-level meetings are not productive at all. The talks so far have not produced agreement on anything. Do you think they've got different staff telling them different things about the state of conversations down in Washington, D.C.?
I think that right now there is a different political calculus to seem like there's progress on one side and not making progress on the other side to try to negotiate perhaps a better deal. All I can say is it's clear as mud, and people are so excited to talk about this yet again, and that is definitely what's going to dominate. My favorite was Janet Yellen coming out and saying, look, this is making the U.S.'s borrowing costs more expensive if you look at the front end. It's like the one area of markets that actually starts to care. It's like, we're going to use that because that's all we got.
We're already seeing us pay the price for this mess and the delay around the conversation. Secretary Yellen actually doubling down on her warning that the ex-state is going to fall sometime in early June and maybe as early as June 1st. We'll come back to that a little bit later. TK wants nothing to do with this conversation. Let's talk the U.S. consumer. Later on this morning, 8:30 Eastern time, U.S. retail sales. We get some earnings from Home Depot. They're dropping right now. Lisa's going to go through that for you. Tomorrow, Target. After that, Walmart. Just getting the top line from Home Depot right now. They see full year comp sales down 2 to 5%. They had seen it previously, Lisa, as approximately flat. So that's a slight downgrade to the outlook from them for sales.
There is a question about whether this really is reflective of the broader consumer or whether this is a Home Depot specific and housing specific type of story. Those shares lower by almost 5%. They said that it has to do with lumber deflation and unfavorable weather. So perhaps there is something that is more specific to the industry rather than a larger statement about the retailers, including Target tomorrow, and Walmart on Thursday.
Over the weekend, they made very clear it's been a very cold spring across this nation. Certainly, we've experienced that in New York with just the first warm days here in the last couple of days. So, yeah, weather's part of it. But lumber deflation really gets my attention, and you're going to see that across other products where they don't inflate. And, John, what you're going to get here is a feed through the income statement where you've got less inflation, less nominal GDP, that animal spirit of the nation, on a price in units basis, perhaps leading to a lesser revenue in the you go down the statement.
Getting some commentary and some numbers as well. So the commentary reads as follows. They observed more broad-based pressure across the business. To Lisa's point, the weather in California disproportionately impacted the results. For the outlook, full-year EPS down 7 to 13%. Lisa, they had previously seen things down in the mid-single digits. So it's a downgrade to the outlook from Home Depot this morning.
In a big way. I mean, the idea that fiscal year sales and comparable sales, they see down 2 to 5% versus flat earlier really highlights this pressure. Again, how much is this a Home Depot issue and how much is this a broader kind of retailer issue is sort of one of the questions of how do you take the idiosyncratic stories and turn them into some sort of broader macro play.
Very quickly, to flip it to a broader view, the Home Depot in Beijing had a tough time over the last months too. We should not forget China's statistics today were a little soggy.
Disappointing.
Tangential, but nevertheless disappointing.
We'll talk about the downside surprises in China in just a moment. Home Depot in the pre-market negative by more than 4%. Tomorrow, Target. The day after, we'll hear from Walmart as well. The broader market just taking a move lower, just a little one on S&P 500 futures, negative right now by 0.2% on the S&P. Yields come in as well, Lisa, by 3 basis points on a 10-year, 346.63.
We'll get a broader read on the retail sector at 8:30 a.m. As you were mentioning, we do get those retail sales, and it's expected to be dominated by auto purchases as well as what we see more broadly in gasoline. However, how much is this really going to be inflation-driven? Home Depot shares lower by almost 5%, as you were saying, as we get the sense that perhaps there is some sort of shift in the consumer. 10 a.m., I'm really focused on this, actually. Senate banking hearing is going to be taking place with Silicon Valley Bank executives, including former CEO Gregory Becker, who says that it's the Fed's fault for basically saying that rates were going to remain low and then raising them. And then at the same time, there is going to be a separate hearing in front of the House Financial Services Committee with Fed Vice Chair for Supervision Michael Barr. So I really want a split screen of Greg Becker basically saying it's the Fed's fault, even though he sat on the board of the San Francisco Fed, but I digress. And then basically Michael Barr coming out and saying, terrible management. Yes, we could have done better, but, you know, banks are going to fail. And then also today, around 3 p.m., is that meeting between President Biden and House Speaker Kevin McCarthy. Do we get any sense of how these talks are progressing? The one area of the market that really cares is the one-month T-bill yield, which has gotten to about the highest since at least 2001. Wow. So we are seeing some moves on the front end, and Jenny Allen is going to talk about that.
Imagine being an investor last year, sitting in tech stocks and getting absolutely hammered and turning around. Well, I listened to the Fed. They told me it was transitory. They told me it was transitory. Can you believe he's blaming the Federal Reserve for that? They told me it was transitory.
Federal Reserve and social media. I mean, talk about finding the most convenient kind of blame games in town.
Wow. Marvin Lowe joins us now, Senior Global Macro Strategist at State Street. Marvin, wonderful to have you with us on the program. Tom wanted to talk about the note from SocGen's Kit Jukes this morning. He said this: U.S. data will dominate sentiment and will probably deliver solid retail sales, decent industrial production. The debt limit remains a major issue, but for now, evidence of recession is missing. Marvin, is recession evidence missing right now for you?
Yeah, I mean, it's certainly not clear. I still think that a recession is unfortunately somewhat unavoidable after the banking situation, and we're waiting for that to make its way through the economy. But the consumer is still strong, jobs are still robust based on the latest numbers, and inflation is proving sticky.
I look, Marvin, at the inflation proving sticky, and yet there's a single headline from Home Depot. Granted, it's a commodity. Granted, it's volatile. But lumber deflation. Are we going to see more headlines like that?
You know what? Probably. The good side of things has been a bit more volatile in this discussion. It does come down to services, wages in this economy, and that's really where the Fed is focused on. And it is the stickiest of the sticky, if you will, parts of the inflation discussion.
But on a global basis, I mean, I looked at copper very carefully this morning. I looked at Newcastle coal in Australia, folks. This is north of Perth. And, I look at these commodities, and the fact is they're rolling over, indicative of a slowing China, maybe a misguess on the Pacific Rim. How do you fold that into your investment allocation at State Street?
Yeah, I mean, for sure, it is signs that you've got growth problems that are starting to emerge as we go through, the 1-year anniversary of this aggressive tightening cycle within the developed markets. Those recessionary signals are all over the place. It is this kind of one slice of the American consumer that's making it harder to play. But I think if you can look past the timing of this consumer, which again, with some of these retail earnings, with some of this data that's coming out softer, you do get to a much slower growth type of discussion. And if you're willing to put those investments in place, they're out there.
Do you think that this is disinflationary to the degree that would give a bit of a reprieve to the Fed, especially if the stress that we're seeing in the banking sector is real, but a slow burn that isn't going to necessitate some sort of real response?
Yeah, for sure. So I definitely am in the camp that this credit tightening that I expect in the second half of the year is going to have a bigger impact on the economy than, maybe some of these risk assets are saying, particularly on the default side of things, particularly on just overall loan growth slowing. And you do get a more disinflationary type of world once we get there. The timing is really hard. It's not really the expertise of global macro to pick one month over another. But going into 2024, I think that those headwinds seem much stiffer.
Where is the debt ceiling debate on your radar? Are you excited? Do you wake up every morning to get a sense of the machinations between the different discussion points that the two parties have?
You know what? If you talk to my coworkers, they would say I get overly excited about it. So yeah, I certainly do think that the market is a bit sanguine about it this time, particularly given the volatility on the deficit side of things. It's just a lot harder to pick the date when we're going to run out of money, and that really creates a problem for Washington, which seems to need that impetus to get things moving. I'm also very cognizant of the amount of reserves that moves around once we get the deal. And that in and of itself creates more challenges for bank deposits, at least in the short term, potentially in the intermediate term, kind of just given how the shape of all these short-term curves are somewhat inverted at this point.
Marvin, let's say we knew the ex-date was June 1st. Would there be a different practical ex-date, a deadline that we had to really come to an agreement on to pass the legislation needed to ultimately skip the dreadful outcomes that most people are predicting if we do go through that ex-date?
Yeah, I think there would be a greater sense of urgency for sure. We are running out of time very, very quickly. The president is still apparently going to the G7. So, again, the litany of conversations that are coming out of Washington show different degrees of concern. And that in and of itself is a concern when you're talking about a date two weeks away. So how you get there is really some sort of, hopefully, acknowledgement that June 1st is a date that we should focus on in a temporary agreement to get us past, or else, we go into territory that we've never been before.
I thought you were done then, Marvin. Just got trigger happy on this side of the desk.
Marvin's killing it. Killing it.
I just hear the gap.
Killing it, yeah.
Let's go. Marvin Lowe, Stay Street.
I'm worse than you.
Marvin, thank you. You are. That's true. I won't disagree with that. Home Depot in the pre-market down by more than 4%, down close to 5% this morning, cutting the outlook for 2023. Get a read on the U.S. consumer through the week. Retail sales coming out in a couple of hours' time, Tom. Then it's on to Target, then on to Walmart.
We talk about two-year yield collared, and so, you're making jokes with Ramo about the euro at 110, collared as well. Home Depot's collared. And the range here, coming off the pandemic celebration recovery, everybody's down at Home Depot. John, I love the Milwaukee 18-volt lithium-ion cordless belt sander. Really helpful at home. That's really, use that on the nails of the dogs. And, they're collared. Home Depot's collared 265.
Sounds like animal cruelty, Ramo. Don't know about you.
Sounds like he's a little bit sick of the bills that he's paying at the groomer.
You got that
How do you
right.
feel about that?
I do this every quarter. Are you ready?
Yeah, let's go.
Have you been to a Home Depot yet?
No.
Okay.
There's one down below us. There's one right
I
there.
know. You've never been?
He's never been.
Have you not done any home improvement ever?
I have the help go.
Like
every
paint,
quarter, still never been.
Hooks, pictures.
No. Stock is down by more than 4%. In the next hour, Ed Yardeni of Yardeni Research. U.S. retail sales about 2 hours away from New York. This is Bloomberg.
Surveillance road trip to Home Depot. That's what we're working on. Yeah, keeping you up to date with news from around the world with The First Word. I'm Lisa Mateo. President Biden meets with House Speaker Kevin McCarthy and other congressional leaders again today to try to avoid a default. And McCarthy says the two sides are nowhere near a deal to raise the debt limit. The standoff has been roiling markets as investors bet whether an agreement can be reached. Ukraine says its air defense system defeated what it called an exceptional Russian missile blitz overnight. The attacks included 6 hypersonic missiles that were aimed at the capital city, Kyiv. Ukraine says it destroyed 18 Russian missiles. Global oil demand will rise more than expected this year because of China's post-pandemic rebounding. That's according to the International Energy Agency. The IEA says world fuel consumption will rise by 2.2 million barrels a day to a record 102 million. The agency expects demand in China to hit an all-time high. Wells Fargo has agreed to pay $1 billion to settle a shareholder lawsuit. The plaintiffs accuse the bank of making misleading statements about its compliance with federal consent orders. Now, that was in the wake of the 2016 scandal over the opening of unauthorized customer accounts. Wells Fargo ended up paying $3 billion to settle the government probe. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Was going to keep rate World Cup. This is a 3.
As the economic picture does.
Is the BOK is getting ready to make.
Bloomberg has the Fed coverage you're looking for. Today, an exclusive interview with Richmond Fed President Thomas Barkin.
Everybody's got a recession playbook, and the reason they haven't turned the pages is that their business actually remains pretty sound.
Then Bloomberg's Michael McKee speaks with Chicago Fed President Austin Goolsbee.
We should gather further data, and we should be extra careful about raising rates too aggressively.
The most in-depth coverage and analysis of the Fed, right here on Bloomberg, your global business authority.
We're only a couple weeks away, but if you listen to the timeline to pass something in the House and pass something in the Senate, you've got to have something done by this weekend, and we are nowhere near any of that. I appreciate the president sliding into talk after 97 days, but there is no move.
Round 2 of high-level talks. A little bit later today, there was House Speaker Kevin McCarthy sitting down with the President of the United States later on the debt ceiling debate, saying that talks aren't constructive, they're not productive. At the same time, Lael Brainerd is saying talks are constructive, they are somewhat productive. You're loving this, aren't you,
I
TK?
hate it with a passion.
But you've got 2 weeks of it.
We may have more of that. You know, they're going to kick the can. The can is kept in a hermetically sealed vault in Providence, Rhode Island.
Who gets to kick it?
I don't know who's going to kick it. That's
Maybe
actually
Kevin
a good
McCarthy,
question.
And maybe President Biden is like who gets to kick the
Maybe it'll
can.
be a joint kick. Who plays Lucy and holds the damn can?
Let's get to the
Probably
price
Wendy
section
Schiller.
briefly. On the S&P 500, we are just a little bit softer on the S&P. We're negative by 0.14%. Yields a little bit lower by 3 basis points. Slightly defensive to kick things off this Tuesday. If you want a stock move, here it is. Home Depot, trying to get up off the floor. We are negative by 4%. Coming out with earnings a little bit early this morning, about 20 minutes ago, 15 minutes ago, and ultimately indicating that the outlook has soured. It's not as good as it was before. They've had to cut the 23 outlook, Tom. This comes ahead of earnings a little bit later this week from Target, from Walmart. All of that still to come, and retail sales at 8:30 Eastern Time.
This goes back to goods and David Rosenberg talking about goods disinflation, good deflation. The headline is lumber deflation, and there's a lot of other things besides lumber, and you wonder where it's going to be. Oil this morning, $71.11 is not $100 a barrel. You know, it's changed.
I'm with you. The data out of China, do you want to talk about that? Downside surprise? Retail sales, industrial production, take your pick, not looking good over there, relative to the boom that people expected at this point of the year.
We'll see that at 8:30 this morning. Right now, not a history lesson, but where are we right now in the silliness of the debt ceiling debate? Joining us is a real authority on this, Wendy Schiller, is director of the Taubman Center for American Politics and Policy at Brown University. Okay, Wendy, so there's the Public Debt Acts of 1939 and World War II, 1941, and then we get to Eisenhower in 53, and the debt's an outrageous $275 billion, and the Senate has a conniption, and they call up Goldfinger, and they sell $1 billion of gold at Fort Knox to cover the debt. I mean, that's the history of this madness. Are we repeating history, or is it new this time?
Well, Tom, I think you're raising an excellent point about sort of the relative scale of debt. I mean, that's what's historical. I mean, right? It's just a huge amount of debt. Now, can we handle it as far as GDP? Well, people say that we can. But even 1974, the Budget Control and Empowerment Act set deadlines for the debt ceiling, as you well know. May 15th, yesterday, was, the traditional deadline. It was do or die. You had to do it by then. And basically the House and the Senate, no matter which party controlled it, met the deadline under Ronald Reagan. And somehow that deadline, like everything else in Congress, has gone away. So right now they're facing, just continuous raising of debt, continuous deficits. At some point, somebody's got to cut something. And we've been at least more than 10 years from a major budget agreement to cut the budget. If Obama had to do it and Biden was his VP, I think Biden recognizes that there are going to have to be some cuts made. I think they're looking for a short-term window, get a clean debt ceiling for the next couple of weeks, and hammer out a longer agreement.
I mean, I got like 10 questions here and no time for it. Let me just cut to the chase as well. The cliche, kick the can down the road, translate that into modern political theory.
Well, the fundamental fact is that most people, given the size of the federal government and the budget itself, cannot trace or track what their member of Congress does, senator or House member, or even the president, and the impact it has on their lives. We keep hearing doom and gloom. The world's going to end. The stock market's going to crash. Nobody can buy a house. There'll be no mortgages. But people don't quite grasp it. And politicians know that people don't grasp it. So they can kick it down the road. They can find all sorts of gimmicks, and they can keep spending. And the other sort of dirty little secret is that Republican members of Congress still benefit from discretionary domestic spending in their districts. So they say they want to cut it, but in fact, if you try to cut agricultural spending, good luck with that. Can't get it done. So this is the real conundrum, particularly the size and scope of the budget.
Ed Yardeni, who's going to be coming on the show of Yardeni Research in about a half an hour time, says that he ultimately thinks that this is going to play out like 2011, except with a more clumsy kind of legislative result. Do you agree?
Yeah, I mean, I do. I think, I would say 2011 and 2013, right? So the grand bargain plus also shutting down the government by the Republicans on the budget side, and then the Republicans doing really well and taking the Senate back in 2014. Republicans do not see a downside to shutting down the government or having an interruption in the flow of federal dollars, just for a little while, because they want to show that the world will still go on. And given that that's the mentality, and even more so now than it was 10 years ago, that's a huge challenge for the Democrats. And where's the Senate in all this? I mean, they basically said, no, we're not going to take the House bill. We're done. But that's not responsible. So the Senate's a huge part of this. And it's the same balance of power scenario as 2011, Republican House, Democratic Senate, Democratic President. So I think that's the big problem. But they know they need a temporary clean because they're not going to get it done in 2 or 3 weeks. And I think can McCarthy get that through his caucus? And that is another pushing it back to McCarthy and the Republican caucus in the House.
Wendy, you were saying that basically this has played well for the Republicans if you shut down the government for a bit. Is this how we can understand the difference in tone between Kevin McCarthy and Lael Brainard, one saying that there's no progress and one saying talks are constructive?
Sure. I mean, the rhetoric has to be, the federal government is bad. That's what the GOP rhetoric is. They give more power to the states, scale down the government, the federal government. And to do that, if you shut it down, then people will realize they don't need it. That never happens. Of course, once you shut it down, people realize they need it very badly in every aspect of their life, and the Republicans cave. But they get political credit for trying to control spending. So this is a playbook that has been very successful for them. And keep an eye on the 2024 House elections, because that's where Kevin McCarthy's attention is can they keep the House? Can they protect those New York and California Republicans newly elected, and he stays Speaker? And that is all he cares about. And understanding what kind of deal he'll cut comes from that motivation.
Wendy, just a final word. You alluded to this just a little bit. Have you got in mind what you think the practical deadline actually is going through all of this?
I mean, it seems to me end of June, early July, by July 4th. I think that's sort of symbolic. They also go on vacation for a week or two, July 4th. I think that's something symbolic. And I think that if they haven't reached it then, not only is there sort of financial catastrophe, but I think there's a lot of political price to pay because they go home to their districts and they're going to hear about it.
So you think that June 1 date is just to put a little bit of cushion there, pad things out just a little bit from the Treasury?
Yeah, you'd certainly hope with people this smart that they'd be strategic about that deadline and knowing, giving themselves a little bit of room there. And I think they'll have to get a temporary clean one passed. This is going to be another test of McCarthy and his power over his caucus.
Wendy Schiller of Brown University. Wendy, thank you, as always. TK, you thought we only had a couple of weeks of this. You might have, say, 6. You might get 6 weeks of this.
That's a can down the road. What happens after 6 weeks? And the answer is in the Wikipedia. It's really cool. They have the debt ceiling raised by President Obama. Then you go down 3 paragraphs. The debt ceiling raised by President Trump. And then you go down 3 paragraphs. And they got the debt ceiling raised by President Biden. Why is there any other trend? I don't see any other available outcome other than to do this. And what I was doing while Wendy was talking there, I went and looked at the Kentucky public disbursements from the federal government. It's ginormous. What are you going to do? Cut off the checks to Senator McConnell's Kentucky? It's not going to happen.
Alluded to that, and your point of view from the investor perspective right now, and this is captured by the fund manager survey put out by Bank of America this morning. The Global Fund Manager Survey suggesting that is overwhelmingly the consensus view, that it's not even viewed as a major risk, Bramo, because most people just assume this gets dealt with.
And that's the reason why, if it does happen, where we do get some sort of shutdown, people will simply buy treasuries because it's a short-term disruption that will cause the things to go along the way that they always have gone along. How much does this actually increase the risk of some sort of massive fissure if there isn't this sort of market pressure? I mean, really, I keep going back to this.
It's a massive fissure dropping into a toxic brew. I just...
Stir it all up.
He's trying to stir it up.
Big time.
The massive debt ceiling fissure.
Most crowded
we've been
trades
here before.
in the BofA survey.
Yeah, I like your tweet
long
on that.
big tech, short banks and short...
We're investing a lot in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bramo romanticizing about freshly cut grass in the commercial break.
Don't believe it or
not.
that.
Believe it or not. It's amazing. Amazing.
I was tearing up.
Wasn't it beautiful? We'll come back to that another time.
No,
It's the hay fever.
we're not gonna be coming back to that.
Pollen counts high today, just so you know, in New York.
Thank you for that PSA.
Anytime, that's what I'm here for. Your equity market on the S&P 500, slightly negative by 0.1%. On the Nasdaq, totally unchanged. Yesterday, snap day, 2-day losing streak, I think, on the S&P with some marginal gains. Check out the bond market. Let me go through some levels for you. 2-year, 10-year. The average on the 2-year over the last month, 4.02%. Right now, 398. The average on the 10-year over the last 30 days, 347.58. Right now, 347. The equity market hasn't done much for a month, and I have to say, the bond market hasn't done much. It's kind of like the bumpy road to nowhere. But something did break in the last week. Euro-dollar did. In the FX market, this currency pair, this was the biggest move lower for this currency pair going back to September last year. Trying to bounce back from that and reclaim 109, 108.93. But I have to say, the data's starting to turn in Europe in an interesting way. We had the German ZEW investor confidence read a little bit earlier. It's not that well followed compared to, say, the business confidence EFO index, which we talk about a whole lot more. But it's another one, Bramo, on top of a few others that I think we have to pay attention to, that things in Europe may be not going in the right direction. And I'd throw into your toxic brew the latest data out of China as well.
I would completely agree. This is sort of the tailwind that really maybe is already used up or already getting a sense of perhaps not being as strong as people previously thought. There was a belief that Europe could somehow emerge sort of dominant and stronger than the U.S., and people are checking that, especially as earnings other than Home Depot usually are coming out better than expected.
This is pushing back against a big consensus view. I'm not saying that consensus has shifted, but you're starting to see a change emerge from the likes of Mislav Matejka at JP Morgan, dropping that overweight Europe versus the United States, saying this: the activity upswing seen around the turn of the year, which was helped by the falling gas prices in Europe and by China reopening, is unlikely to transition into an acceleration in the second half. That's the story for Europe, for some of the data.